In this episode of Influencers, SEC Chair Gary Gensler.
I come with a deeply markets background. I really believe in markets. I think markets are a critical part of our economy, but regulated markets. The events in Eastern Europe just, sort of highlight once again the importance of cyber resiliency. If you're raising money from the public, and the public's anticipating some profit based on the efforts of those folks raising the money, that comes within the definitions of a security and the securities laws, and it's kind of straightforward.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Gary Gensler, Chair of the Securities and Exchange Commission. Gary Gensler was sworn into office as the 33rd chair last April, and in a little under a year in office, he's pushed the SEC right into the middle of the conversation surrounding cryptocurrency, meme stocks, and other issues as well. Chair Gensler, thanks so much for joining us.
Andy, it's so good to be with you and your viewers.
Thank you. A whole lot to get to, but I want to start with the news in Ukraine, especially the reaction from the business community. The New York Stock Exchange recently moved to temporarily halt trading for Russia-based companies. Have you been monitoring that, and should it be a permanent ban?
So just stepping back from any one circumstance, the staff of the SEC are monitoring markets as we do through these times. Throughout the whole time that I've been at the agency, it's not just about the geopolitical events in Eastern Europe. But yes, they're monitoring. We're staying close to those events. We're talking to our colleagues at the U.S. Department of Treasury and across the financial regulatory complex, the Federal Reserve, and other regulators, as well as globally to regulators in the banking and the securities fields across the globe, just to stay close and monitoring events with these really unusual events out of Eastern Europe and war in Ukraine.
Do you feel you have enough transparency into U.S. corporate exposure to Russian assets and the Russian economy? Do you have worries about hidden U.S. connections as the Russian economy may be headed for a recession or worse?
Well, Andy, I'm going to stick to our remit at the Securities and Exchange Commission, which is about overseeing, yes, $100+ trillion capital markets and ensuring that they're fair and orderly, efficient. And in these unusual times, we're monitoring for that. But I do feel that we've had good dialogue with major market participants in the fund area, in the broker-dealer area, the exchanges, the clearinghouses, and at least for these handful of days so far, the market functions have been operating relatively well. But what comes tomorrow, what comes in the future, we're monitoring against events as they come.
I understand it's not straight ahead into your remit, but obviously, as you suggest yourself, there are implications potentially, and potential even systemic risks to the global macro system. One last question here, Chair Gensler, about that though. Are there actions the SEC is taking or considering taking in response to what's going on in Ukraine and Russia?
Again, we're staying alert and monitoring. We're staying close with the rest of the Financial Stability Oversight Council agencies and our colleagues around the globe. If you look at funds under management, the total multiples of tens of trillions of dollars of assets under management here in the U.S., only a very small percentage, measured well below 1%. In fact, only a fraction of 1% are invested in Russian securities or ADRs traded overseas and things like that. So yes, we're going to continue to monitor and especially stay alert for any cyber risks or any other market functioning risks. But I think that's what our role is. And then to ensure for our three-part mission: investor protection, capital formation, and then that in the middle, the fair, orderly, and efficient markets.
Okay, sounds good. Let me ask you about crypto, which is part of your purview, I guess, increasingly, and something you've been considering a lot lately. I know last time you were on with Yahoo Finance, the prospects for a spot Bitcoin ETF came up, and you had a lot of questions about how investor protection would work there. Have your concerns been alleviated? Is approval coming, do you think?
Look, we at the SEC are technology neutral, but we're anything but public policy neutral. And so this investment class, a little less than $2 trillion of assets of valuation in cryptocurrencies, if you wish, or crypto tokens, Bitcoin and all the other tokens, is a highly investable asset at this point in time. Many tens of millions of people around the globe have chosen to put some of their savings into this space. And so it's every bit as important to have investor protection for crypto exchanges, for the lending platforms where people are transacting, buying and selling crypto tokens, and have appropriate disclosure about the tokens themselves and protect the public from fraud and manipulation. And that's really what we're looking at. And yes, as you said, the SEC has a role to play. Other agencies do as well, but the SEC has a role to play because Congress painted with a broad brush. And if you're raising money from the public, and the public's anticipating some profit based on the efforts of those folks raising the money, that comes within the definitions of a security and the securities laws. And it's kind of straightforward. Congress saw that was an opportunity to mislead the public, to sell a sham transaction, that the public could make a decision, the basic bargain. The public gets to decide on their investments as long as those promoters raising money are giving full and fair disclosure. And there's basic laws about protecting against fraud, in essence, lies about what's going on.
Right. And sort of following up there, you also told us that you hope this year crypto trading exchanges would come
within the public policy perimeter. Look, we had just a couple of weeks ago working with one of the larger lending platforms where a platform was taking money in. It's public. It was BlockFi. 600,000 or so retail accounts and institutional accounts, people putting their crypto assets at risk with BlockFi. BlockFi then saying, we'll give you a return on an account. We're trying to bring those parties in. In that case, that was they were not following the securities laws, investment company laws, and the Securities Act laws.
So does that mean, though, that the exchanges will come under SEC regulation, strictly speaking, this year?
Just do a little bit of probabilities here. I'm sort of a math guy. I was when I was a kid. My identical twin brother and I, that's kind of who we were and everything. But these platforms often have not just dozens, but hundreds or thousands of tokens on their platforms. And these tokens, back to the securities laws, many of them, without prejudging any one of them, many of them may well be securities. Probabilities are that these platforms, there's 10 or 15 large platforms, these crypto trading platforms, have 75 to 5,000 tokens on them. Probabilities are they have securities on them. Our laws are straightforward. You're supposed to register as an exchange where people are buying and selling those securities. And yes, many tokens, many crypto tokens have been found in the past to be securities. And I'm not trying to prejudge any one token, but probability weighted, there are many of these tokens on these platforms.
Oh, so what's the probability then of you waving a wand and saying, okay, you guys are now
I don't think the law is clear.
Yeah.
The law is clear. It's not about waving a wand. Congress spoke about this in 1934. They amended these laws multiple times since over 9 decades. And a platform that has securities on it is an exchange. It's a question whether they're registered or they're operating outside of the law. And I'll leave it at that.
Are you concerned, Chair Gensler, about the decrease in the number of public companies in the U.S.? And I know there's arguments about how extreme that decrease is. Nonetheless, there are fewer today than there were 20 years ago. And then the fact that private companies grow into deca unicorns and are great investments, perhaps, but they're unavailable to ordinary investors. They're only available to the people on Sand Hill Road, and how that might be exacerbating inequality in this country.
So I think that we have vibrant capital markets, this $100+ trillion capital markets that are kind of the envy of the world, frankly. I think anyone who's honored to be in the role I'm in, as you said, Andy, the 33rd chair, and there'll be others, for decades to come in this great agency. Central to our roles as chairs, past chairs and future chairs, is to ensure that we continue to be the envy of the world, that we have the leading capital markets. And we have a vibrant public capital markets and vibrant private markets. we are taking up a lot of projects here at the SEC about those private markets to bring greater transparency, greater efficiency. If we have more efficiency and yes, competition in the middle, that's better for those private companies, whether they're small startups or the unicorns, and it's better for the investors. So we're trying to drive efficiency in the middle. We're also trying to drive for greater transparency, particularly as it relates to financial stability risk emanating maybe out of hedge funds and the like. So we've got a lot of projects driving competition and transparency, but part of our markets is both public markets and private markets.
Speaking of the envy of the world, what is the future of Chinese stocks listing in the United States? Does the SEC have a role or a position in this situation, one way or the other?
So we do. So we're blessed in the U.S. again with such robust and strong capital markets that between 1,000 and 1,500 foreign companies actually list their shares here in the U.S. And it's not just China companies, but a lot of Europeans, Asian, South American, African, Australian companies. It's just from all around the globe. But there's some basic understandings that if you want to list in the US, you need to comply with our investor protection rules. And one of the key things that came out 20 years ago, one of the key things was that if you want to be issuing and raising money in the US, that you have to be not only audited, that the company has to be audited, but the auditors have to be open to inspection. Kind of simple idea, audit the auditors. And Paul Sarbanes, a Maryland senator who I had the honor to work with, Chair Sarbanes, passed that law 20 years ago. Bipartisan, with Republicans on the Hill, with Mike Oxley, and with President Bush. 20 years later, 50 plus jurisdictions around the globe have allowed U.S. entity called the Public Company Accounting Oversight Board to audit the auditors, but China has not. So Congress weighed in again 2 years ago, or a year and a half ago, and said, no, that's not right. And they put a clock that had to happen. So where are we today? I think it's really, we've had some good discussions with our counterparts from China. The Public Company Accounting Oversight Board has had some good discussions, but it's really up to the officials in China. If they allow the auditing firms in Beijing and Shanghai and elsewhere to be inspected, and that their work papers are actually shared, and not with a lot of redactions, but actually shared. Right. And their auditors actually allowed themselves to be, give interviews and testimony like 50 other countries have done.
Right. Then
there's a path forward. Otherwise, Congress has spoken about 250 Chinese companies in this 3-year clock, potentially as early as 2024. Would have to suspend trading here.
Another proposal in the works is specifically in response to last year's meme stock craze. I believe it would shorten the amount of time it takes to clear trades. How would last year have played out differently had that rule been in place? So
the events around the meme stocks, or as you know, GameStop, led to a review by the SEC, and the staff came up with 4 areas we should take a look at. And we have, in 2 of those areas, put out proposals. 2, we've working on some more. So one is what you talked about, is the basic plumbing, shortening how long it takes for money to move and stock to move. It's called settlement period, from 2 days to 1 day. We've also done something around transparency around short selling, and made a proposal last week around that as well. Shortening the settlement cycle lowers the risk in the system. As the old saying goes, time is money. Right now, if you do a trade on a Monday, you don't move the money or the stock until Wednesday. You shorten that to Tuesday, less risk. in the middle of that January, the fateful January around the GameStop events, a number of online brokers and brokerage apps said, we can't let retail public access the market. And that's just, that access to the market is so fundamental that part of the issue was this settlement cycle thing, but it's not the only thing. And as I say, we have 4 projects. We've proposed 2. The other 2, looking at really the equity market structure itself and payment for order flow and the dark pools of capital that are flowing without transparency. That's a major project that I'm hoping staff will make recommendations and we'll move forward. And lastly was this thing called gamification, or what we've come to call digital engagement practices.
The Wall Street Journal has reported the SEC is looking in recent sales by Tesla CEO Elon Musk and his brother Kimball whether they violated insider trading rules. I know you can't comment on a possible.
I'm glad you said that for your viewers.
Yep.
I'm not sure where you're headed.
Oh, so I'm going somewhere. Chair Gensler.
All right.
I know you can't comment.
I'm not going to be able to comment
on a possible investigation, but have you talked about the need for stronger insider trading rules generally? How big an issue has this been in your first year? Is insider trading a problem that you're focusing on?
It is. It is from our enforcement side, our terrific enforcement efforts headed up by Director Grewal, Sanjay Wadhwa, the whole team, just terrific team. But it's also from the policy side. We've even done something about insiders. When can corporate executives sell their shares? And there was something put in place about 20 years ago, which was called a safe harbor, if you might. And we came on board and thought there's too many gaps in this area, that in senior management might be trading stock when they're in receipt of material non-public information. And we put this proposal out in, I think it was December or so, about these so-called 10b5-1 plans. And so both from really vigorous enforcement, but also from the policy side about insiders, we're taking it up in both ways. And I think it's a really important part because it comes down to trust in our capital markets and trust that there's a level playing field, that when you're in the markets that somebody doesn't have an information advantage from material non-public information.
What are your feelings about the debate on Capitol Hill right now about lawmakers being able to trade stocks? My understanding is the SEC employees have pretty tight restrictions, with some stocks being off limits and trades needing to be pre-approved. Is that fair? I mean, should it be the same for everyone in all different branches of the government?
Look, I'm going to leave that, as you could imagine, to Congress to think through. Certainly, we're willing and able to give them technical assistance on that. The Stock Act that was passed about 10 years ago by Congress and set certain reporting obligations on members of Congress, and also certain limitations as well. We as an agency actually have a role to play in that Stock Act. And that's ongoing discussions, I know, up on Capitol Hill, and wherever they come out, we stand ready to help implement our part of that if they change those laws.
And finally, Chair Gensler, other recent SEC chairs, including Jay Clayton and Mary Jo White, came to the job from more of a legal background. You worked as a banker at Goldman once upon a time ago. How has that background and the insight you garnered there changed how you approach these issues in running the commission? Is it any different?
Well, I'm honored to be in this job. I mean, the then President-elect Biden asked me to do it. It's one of the greatest honors of my life. Right up there with my three daughters, I guess, but my three daughters may be higher honor, and the wonderful woman I was married to. I would say this: I'm the fifth chair of those 33 that is a non-lawyer. From the first chair, Joe Kennedy, the President Kennedy's father, Arthur Levitt, William Donaldson, some really, really fantastic chairs. Look, we all come with different backgrounds, different perspectives, different experiences. I come with a deeply markets background. I really believe in markets. I think markets are a critical part of our economy, but regulated markets. I think that the laws put in place in the 1930s, in this 8-9 decade period of the SECs, that what Franklin Delano Roosevelt laid out, and many really wonderful people at the SEC and on Capitol Hill too, have augmented, is we've enhanced economic growth. Because when you enhance trust, this basic concept that if investors get to decide, but they get full and fair disclosure, and we protecting them against fraud, that the exchanges have to register, but there's a basic rules of investor protection and this three-part mission to facilitate capital formation, investors, and the efficient markets in the middle. I think that's a really great bargain. Now, for me, I've also had the great honor to chair another agency. So along with Mary Shapiro, Mary and I are two people that have chaired both the Commodity Futures Trading Commission and the SEC. So it's great to talk to my former chairs. There's 8, I think, of 8 or 9 now that are still alive, and I call them on a regular basis. I check in. And there's just a terrific group of commissioners, my fellow commissioners, Allison Lee, Hester Peirce, and Caroline Crenshaw. And we all bring a little bit different skills and perspective, and we bring it together.
Gary Gensler, Chair of the Securities and Exchange Commission, thank you so much for joining us.
Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
In this episode of Influencers, Hermitage Capital Management's CEO, Bill Browder.
Are we ready to go to war? Is the United States ready to go to war with Russia? I think that this is going to lead to a Russian depression. I can't imagine how this stranglehold doesn't really drive the GDP down like 20%, 25%. It's remarkable. And we're just in the early stages of this game. The Ukrainians are not gonna roll over. They're gonna fight like hell.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Bill Browder, CEO at Hermitage Capital and head of the global Magnitsky Justice Campaign. In the late 1990s and early 2000s, Browder's firm delivered stellar returns by exposing corruption at major Russian companies, bringing about company shakeups and boosting share prices. In 2005, Browder was denied re-entry to Russia and later became a victim of a Russian government scheme to undermine his firm, he says. Sergei Magnitsky, a lawyer hired by Browder to investigate Russian corruption, was arrested and died in Russian custody. Bill, welcome to Influencers. Thank you so much for joining us.
Great to be here.
So much to get to right now. I want to ask you maybe first of all about Vladimir Putin. And have you ever seen Putin reverse course in 25 years of watching him closely? Can you see him changing his tack now in Ukraine, now that he's committed to a full-scale invasion?
That's that's the most important question of our discussion. And the answer is a definitive no. Vladimir Putin can't. You have to imagine his world is the world of a prison yard. In a prison yard, you can't show any weakness. If someone comes at you with a shank, you got to shank them 10 times more and look around at everyone else and say, who else wants to be shanked? That's Vladimir Putin's mindset. That's how he operates. And so when he has embarked on this horrific military invasion, there's no chance. Anytime he announces peace talks, that's just a tactic to either split up the resolve of the West or to delay some action to resupply or something like that. And so he is going to move forward. He's going to escalate. There's no retreat. There's no compromise. There's no diplomacy. He's all in it for victory, however he defines that.
And so a lot of people use this phrase end game, Bill, but I'll ask you, I mean, what is the end game here, specifically with Ukraine first? And does he want to occupy it, or how would this work in his mind?
Well, this is another important part of Vladimir Putin. There is no end game. So what you have to understand is he is not there for all the reasons that he says he's there. You can't believe a word he says. He's an inveterate liar. His credibility is zero. And so any words that he has used to describe what he's doing should be discounted. The reason that he is in Ukraine is because after 22 years as a dictator, he sees the writing on the wall. He sees the writing on the wall, meaning that the Belarusian dictator next door was almost overthrown 18 months ago by his people. The Kazakh dictator, again, next door in a different direction, was overthrown. And Putin realized that it was just a matter of time before the Russians overthrew him. And so, pulling straight out of the dictator's playbook 101, he said, what do you do to not get overthrown? You start a war. And he's described Ukrainians as Nazis and drug dealers, and he's described NATO as an invading force and all sorts of things. He doesn't believe any of that. He's just trying to come up with a narrative to give the Russian people something to chew on in order for him to have a war, and his war is there to stay in power. And so when you say, what is his end game? There is no end game. His end game is to move forward, to expand, to attack, to take territory, to declare victories. But he has to keep on going no matter what it is. And this is just part of that process. And it's not like it just started now. I mean, the most recent version of this just started now. He was feeling under pressure in 2008, and that's when he invaded Georgia. In 2014, the same thing. He took Crimea. And so this is a long process of him trying to stay in power as a dictator. And the most scary part of this whole story is that I don't have any belief that he will stop. So let's just say that he's successful in Ukraine. And that's a very big question because the Ukrainians are valiantly fighting back. But let's say he was successful in Ukraine. That's not the end of his story. He would then go to other countries, maybe the easy ones, maybe the hard ones. Maybe he grabs Moldova at some point. But the ultimate goal for him is to show up at the border with us, which means Estonia or Latvia or Lithuania or Poland, and then to test out something that has never been tested before, which is, are we ready to go to war? Is the United States ready to go to war with Russia to protect Estonia, a country of 1 million people that probably 2% of Americans could locate on a map? Are we ready to do that, or are we not? And he's taken the bet
Right.
that we're not.
But isn't this going to be very difficult for him just to hold on to this real estate? I mean, look at Afghanistan, very different country, certainly, but look at Afghanistan under Brezhnev. I mean, there's a huge cost to occupying these countries, right?
Absolutely. So I was just saying, I was saying that's his assumption, is just keep on pushing out. Now let's talk about Ukraine specifically. So he's launched an invasion of Ukraine. We don't know the exact number of casualties, but I've read various reports to say that there's 3,000 soldiers have been killed in the first 4 days of their occupation. I don't know if that's true or not. Maybe it's wildly exaggerated. Maybe it's totally true. But let's just take for a moment and say it is true. That's the total number of soldiers that died in the entire war with Chechnya. That's like a third, or between a quarter and a third of the total number of soldiers that died after 9.5 years in Afghanistan. And so he's paying a hefty price. Even if it's just a fraction of the 3,000, he's still paying a hefty price for what he's done so far. And we're just in the early stages of this game. The Ukrainians are not going to roll over. They're going to fight like hell. Thankfully, now after some resistance, all of the major Western allies are going to assist them with equipment to help them fight and give them some decent chance. But at the end of the day, Vladimir Putin is way outgunned them. I mean, he's got all sorts of stuff. Right. There was, shocking military hardware that could really, be unbelievably destructive to people in Ukraine.
it appears, or one could argue, that the Ukrainians are winning the war of social media. And I'm wondering if Vladimir Putin, who supposedly was this expert in disinformation in social media, has underestimated the Ukrainians' abilities there.
Well, so the Ukrainians have had some help, and as critical as I am on some aspects of U.S. foreign policy, the Biden administration has done a fantastic job early on of sharing intelligence about what the Russians were up to and repeating it and repeating it and repeating it. So by the time the Russians invaded, there was no alternative narrative. So the way the Russians normally do this, and they did this with Georgia, for example, there was like confusion to this day about who fired first in Georgia. And the Russian apologists said, well, it was the Georgians who precipitated and provoked this war and so on and so forth. There's no uncertainty about this. This was a war of aggression. And that's a very important term. A war of aggression is the term they use in the Nuremberg trials. This is a war of aggression that everybody can agree on. And so there's nobody who no sort of natural Russian apologist, nobody who's got a lot of financial interest with Russia who can say anything other than this was a brazen attack on a peaceful neighbor. And that's an extremely important part of the narrative that has allowed all the Western countries to lock arms and do the coordinated sanctions that have been done right now, which are causing enormous financial pain to Vladimir Putin.
Yeah, let's drill down into that, Bill. Sanctions. How effective are they right now, and what grade would you give them, for instance, and what do we need to do from here?
So I'm a sort of connoisseur of sanctions, if such a thing exists. And so when they first started this sanctions program about a week ago, last Tuesday, I would have given the Western governments a 2 out of 10. It was all very, too little, too late. Then the atrocities started to happen, and the sanctions started getting real when they added the major Russian banks, the big oil companies, et cetera. By Thursday, it was an 8 out of 10. Then they did SWIFT. That's a 9 out of 10. And then they did Vladimir Putin and 9.5 out of 10. So there's still some gaps that need to be filled in. SWIFT is only done, so SWIFT means disconnecting the Russian banks from the international financial system, and they've only done 70% of the banks. And so logic would tell you that if 70% of the banks are disconnected, they'll just route all the payments through the 30% of the banks that aren't disconnected. That's just what anyone would do, and certainly the Russians will do that. And so we need to sanction the other 30% of the banks. And a lot of people ask me, why are those banks protected? And I can imagine that there was some ugly backroom deal with, in a smoky room where somebody said, we have an interest there, don't do that. But so those other 30% of the banks need to be sanctioned, disconnected from SWIFT. And then the most important part of the whole exercise is that Vladimir Putin's own money needs to be hit. And his own money is held not by himself, but by oligarchs who look after it. And so we need to freeze the assets of the oligarchs in the West. And a lot of announcements have been made that that's the intention. A few oligarchs have been added to the various EU, US, UK sanctions lists. But that needs to be done in a much more coordinated manner, because there's different oligarchs in the US that have been sanctioned in the EU and different ones in the EU than the UK. And then a list needs to be expanded dramatically. So there's 50 or 60 or 100 of the most wealthy oligarchs in Russia sanctioned. And if we get
God, let me interrupt. I'm sorry, Bill, but practically speaking, how would that be accomplished? Isn't that extremely difficult? You've got Caymans and countries like that, and I don't mean to disparage them specifically. There are all sorts of money havens around the world. Never mind Switzerland, which has said that actually they're up against Russia at this point. But how would that be done practically?
Well, it's actually not as complicated as you think. So, so it's not the government's job to necessarily track down the assets. The way it works in practical terms is a person gets added to the sanctions list. Once they're on the sanctions list, then it's the job, or the responsibility, not the job, but the legal responsibility of a bank that holds their money to no longer transact with that person. So that money gets frozen, or a real estate agent not to sell their property, or a broker not to sell their shares. And at that point, everything gets frozen. And so it effectively gets crowdsourced. Now, you made a good point, which is, let's say their stuff is not in the United States or in the UK, but in the Cayman Islands. Well, guess what? The Cayman Islands is a crown dependency. And as a result, every one of these Guernsey, Jersey, Isle of Man, Cayman Islands, British Virgin Islands, they copy the British sanctions list. And so you end up in a situation where whatever Britain does, all these offshore jurisdictions do. And so Britain is really punching way above its weight in terms of its importance in this whole scheme. And so just coming back to the original thought, you put a person on the sanctions list, they get sanctioned everywhere, Cayman Islands, BVI, UK. And if all the countries coordinate, then there's really no civilized place they can hide. Now, we're seeing oligarchs scrambling right now, moving yachts. I read a story about one oligarch who's parked his yacht in Saudi Arabia, okay, because he doesn't think that the Saudi Arabians will freeze his yacht. And there's stories about mad scrambles of oligarchs trying to sell properties, give them away to family members, and getting divorced from their wives and giving them property, all sorts of interesting stuff. And that will happen, and they will probably succeed in protecting some of their assets. But even if you don't get all their assets, just having a person on the sanctions list means that they're no longer, that they're pretty much out of the game. They're benched in the world, right, in the international financial world.
Another remarkable development, or correct me if you think I'm wrong, Bill, is the response by the private sector, both in Europe and in the United States. I mean, everything from Disney to Shell to the banks curtailing or ending their financial relationships with Russia. What do you think about that? And is this effective?
Well, in a certain way, I would almost argue it's more effective because, okay, so the sanctions lists are important, government activity is important, but if every Western company stops doing business with the Russians, it's really dramatic. I remember when I started my whole campaign for justice for Sergei Magnitsky, my murdered lawyer. One of the first people I met with, I was in South Africa, and I met with a woman named Helen Zilli, who was one of the people involved in the one of the main people involved in the anti-apartheid movement. I'd watched a movie called Cry Freedom, and she was one of the characters in the movie. And I met with her shortly after Sergei Magnitsky was murdered, and we talked about how they ended apartheid. And she said it was all about disinvestment. It was all about the U.S. and Western Europe disinvesting from South Africa, that when they became financially isolated, that's when it became too much. And so I think this is really, really important. And I think this is probably, as I look at the next steps, what can we do next when we watch these atrocities unfold in Ukraine? I think it's just to pressure every single Western business to divest, to stop doing business, to stop supplying goods, to stop supplying services to Russia.
Right. Are the sanctions enough to send the Russian economy into recession? And is this an objective that we should try to achieve even?
Well, if you had asked me 2 months before this whole thing had started, I would have said, let's just go after the oligarchs and leave the Russian people alone. We have got no beef with the Russian people. They didn't do anything. Most Russian people don't want this. I would say the vast majority don't want this. They don't want to send soldiers into harm's way to be killed and mangled. They don't want to have to pay 100% more for food and imports, which they're not even going to get anymore. No more imports. I think the average Russian person doesn't want this, and so I wish that we had done this before, and possibly sent Putin a message how costly this would be in a real way that he would understand it, so he wouldn't have invaded. But he has invaded, and so now we have to say, okay, what's the strategy going forward? And the strategy has to be to raise the price as high as possible, and most importantly, to just deplete Vladimir Putin of resources so that this war becomes so expensive and he just doesn't have the money because the central bank reserves are frozen, the exports are not generating any income, no more foreign direct investment at all. And so we're in a situation where he just can't afford it anymore.
I want to get to your personal background a little bit, Bill. To have a fascinating story. We talked about it a little bit with your firm and all of your trials and tribulations in Russia, investing there. After your ordeal battling the government in Russia, you became a global champion of the Magnitsky Act, which allows the US and other countries to sanction foreign officials involved in human rights abuses. Validating or infuriating to see the need for such laws at a time like this?
Both, but most interestingly, so the Magnitsky Act works for human rights abusers and corrupt officials. It was passed in 2012, and it completely Putin blew his top when he saw this happen. And I mean, really, just like, I mean, in the most emotional way, he banned the adoption of Russian orphans by American families in retaliation. And the orphans that were being adopted were the sick ones, the ones who were not well. And Americans would still take these children back to America and nurse them to health, and they tended to die in the orphanages. So he's effectively sentencing orphans to death in his own country as a retaliation against the Magnitsky Act. And everybody was scratching their heads and saying, why is this guy reacting so harshly? And the reason is we can see it today, literally today, which is that this was the basis for which all of future sanctions were modeled on: asset freezes and travel bans. And every person that's now going to be sanctioned will basically be sanctioned on the basis of the Magnitsky Act. And the reason he was so upset was because he knew, he's not stupid, he knew that eventually the Magnitsky Act would come for his money. And so there's a direct line between the murder of Sergei Magnitsky, my campaign for the Magnitsky Act, the sanctions that were put in place, and the sanctions that are now going to go after Putin's money.
In 2018, Putin mentioned you by name during a press conference with then President Trump, offering to allow U.S. investigators to interview 12 Russian intelligence agents identified by Robert Mueller's probe in exchange for allowing Russian intelligence to question you and others close to you. Trump later called it an incredible offer. What is your view of the way Trump reset U.S. relations with Russia? And do you think it affects the way the world approaches Russia today?
Well, thankfully, I think that the Trump situation was an aberration. I don't think it was like a permanent damage to the relations between the United States and the rest of the world. And I don't think it certainly hurt the U.S. credibility for a short period of time. But we can see right now in the multilateral approach towards sanctioning Russia that things continue to work as they should. I mean, it's pretty horrifying, the idea that an American president would hand over me and a bunch of US government officials to Putin because Putin asked for that. I mean, it's just unbelievable, really. And it also seems pretty unbelievable. It took him 4 days to walk it back. And it was only after the Senate had a vote whether or not to hand us over. And they voted 98-0. About 20 minutes before the vote, Trump, through his press secretary, declined Putin's offer. But if Trump had been reelected, so that was during the Mueller probe. So and so he was sort of under the spotlight as far as Russia goes. If he was reelected, I wouldn't have been able to travel back to the United States because surely he would have handed me over to Putin. And so I from a personal safety standpoint, I breathed an enormous sigh of relief when he was defeated.
And final question, Bill, going forward, what sort of work do you see yourself doing, and what sort of legacy do you see yourself leaving?
Well, the legacy that I'm in the process of leaving is a legacy where Sergei Magnitsky's name is on legislation, not just in the United States, but now in 34 countries, sanctioning human rights abusers, not just in Russia, but all over the world. And so the Magnitsky Act now applies to Chinese officials involved in the genocide in Xinjiang, is involved in, it sanctions Iranians, Myanmar officials, all sorts of bad actors all over the world. And it creates a big disincentive to human rights abusers and to kleptocrats. And it also creates some redress for victims. And for me, the Sergei Magnitsky's murder is a burden of guilt that I carry with me everywhere, because he was my responsibility and he was killed in my service. And so every day that I do something to enhance his legacy and to do that in a way that potentially will offer other victims redress and save lives is sort of my project. And I, as more and more countries do this, then the next step is to have more and more countries use the Magnitsky Act against bad actors. And so Sergei Magnitsky will, from the grave and from heaven, be helping everybody else out in their terrible moments of distress.
Bill Browder, CEO of Hermitage Capital Management and head of the Global Magnitsky Justice Campaign. Thank you very much for joining us.
Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Using some stuff from GNC, maybe a little Peloton bike, and maybe that Beyonce diet.
Can we do the side-by-side picture again? You got to make the same facial expression.
You're going to make me do it.
There it is. There it is. That's close. That's
why they pay us big bucks, Brad.
There we go.
We can do that real time.
Guys, coming up, the best of the worst, why despite the pain at the pump, you should be thankful for filling up your tank in the U.S. That's next.
Welcome back to Yahoo Finance Live. I'm Brian Sazzi alongside Brad Smith. Julie Hyman is out on assignment. Limping into the weekend, that is the vibe on Wall Street after a brutal week for the markets. We are seeing some tepid buying across the board with the Dow in the green, the S&P 500 and Nasdaq also clinging on to modest gains. Now, here are three things you need to know right now. Crypto carnage. We'll dive into the outlook for the crypto complexes. Everything from Bitcoin to Coinbase to have been routed this week. Right now, Bitcoin prices are clinging to that $21,000 level. Tech wreck. Crypto isn't alone in having a tough week. Tech stocks have also continued to be hammered on fears of much higher interest rates, but there are some names that you should be perhaps looking at on weakness. We'll explore just that. And with the NBA Finals all wrapped up, we'll talk to an analyst from Macquarie to break down the sports betting world. But back on the economy, from rising rates to falling stocks, it's been a wild week for both the U.S. economy and Wall Street. Our next guest says while the Fed's aim to bring inflation under control is necessary, it may feel like the cure is worse than the disease. Joining us now is Beth Ann Bovino, S&P Global Ratings Chief U.S. Economist. Beth Ann, always nice to get some time with you. Look, it's been a wild week here for the markets, for the economy. As we look out to the rest of the June, where do you think we might see the economy head?
Out through this month. I mean, this month, I think things are going to hold up relatively well. We are starting to see signs that consumers are pulling back, and that's not just on low-income households. You're starting to see, well, you mentioned the crash in the equity markets. That usually has an impact on the wealth effect, affecting higher income households as well. So we expect to see that slowing down. But generally, the U.S. momentum in the economy at this point in time will hold up. Doesn't mean it'll last forever, and that's where we're concerned going into 2023.
Beth Ann, markets will typically price in a recession prior to it actually showing up in the economic data. But a question particularly is how deep of a recession might markets be trying to price in?
I would say that, markets are fearful, understandably. We're talking about the Fed moving much more aggressively than that they had earlier indicated. And indeed, they came out with a 75 basis point rate hike without giving us any guidance beforehand. So that seems to see that the Fed's scared. And when the Fed's scared, the markets are scared, pricing in a much more aggressive Fed policy. And that means an aggressive response to a recession. Now, whether the markets are right or wrong on the recession remains to be seen, but there's a lot of headwinds. Now, we see the risk of a recession increasing rather dramatically. We had it at 35% for 2023. It looks like it's climbing higher, but the size of the recession is the real question. And given we do have buffer both with the household balance sheets and business balance sheets, we suspect that the recession might not be as severe as markets fear right now.
What is that ultimate trigger point, Beth Ann, that tips us into a recession?
Watch what the consumer does. The consumer makes up, close to 70% of economic activity. We're watching them. It looks like they've blinked, and there's understandably so. When you have food and fuel making up the biggest size of the consumer basket, meaning there's not much left to spend on discretionary items. You mentioned toys. I felt bad for the children, but that might be one area that's cut, and that means that when people stop spending, the economy weakens. I also watch as a near-term indicator what happens with the jobs front. Those initial jobless claims numbers is a leading indicator according to our business cycle barometer, and that's something that we're keeping a sharp eye on.
Even with his comments this morning, Fed Chair Jay Powell tossing a big question mark into today's tape, and we've seen that play out as the Dow has kind of waffled in and out of negative and positive territory. With all of this in mind, this week for the Fed in aggregate, the recession concerns that have been brought up within the conference call, this is the same committee that said inflation was transitory at the end of the day. Did Wednesday's decision and the press conference do enough to, I guess, alleviate some of the credibility concerns coming into this FOMC meeting?
I think the Fed will hopefully be able to pull back the reins and get control of the narrative. But right now there is a lot of there's a lot of challenges they face. They also noted in that press conference that indeed a lot of things are out of their control, and that's true and understandable. Meaning that their tool is basically interest rate policy and monetary policy, which affects demand. They can't control the supply chain response, and that, while it's very true, it's certainly not very comforting for markets, I believe.
Beth Ann, how damaging is it to consumer wealth if gas prices stay above $5 a gallon looking out into the year end?
I think that on the low end of the income bracket, food and fuel, particularly food, which is at as you mentioned, a new record high, is going to squeeze the low income households. We saw it before. It was that if you look at disposable income, again, this is from 2019, and it's gotten a lot worse since then. We saw that about 12% went to energy spending. For high income households, it's a lot lower. It's closer to 2%. This goes back to 2019, but it's still about the same. It's all gone up because of these prices. That means less money for these households to spend, and that's a real squeeze. You mentioned the equity crash. We're in in a bear market now. That also is a leading indicator for recessions as well, if it lasts long. And right now it feels like it will.
Beth Ann, always great to get some of your time and really discuss what some of these macro impacts are and what everybody's navigating through right now. Beth Ann Bovino, who is the S&P Global Ratings Chief U.S. Economist. Thanks so much for the time. Have a great weekend. And every American is feeling pain at the pump, but we actually may not know how good we have it compared to other places in the world. Yahoo Finance's Inez Ferre joins us now. All right, Inez, how good do we
Sell
have
this one?
Right, that's right. And this may be little consolation, of course, for consumers here in the U.S. that are paying $5 a gallon for gasoline. But look, if you take a look at other places in the world, particularly Europe, you are seeing gasoline or petrol prices higher than here in the U.S. And part of that has to do with the tax system in Europe and the heavy taxes that you have on these gasoline there in these European countries. But look, Germany's paying north of $7 per gallon. Of course, they go by liters, but when you convert it to gallons in US dollars, these are the prices. France, Italy, Spain, UK is paying more than $8 a gallon. You've got Norway paying more than $10 a gallon, and Hong Kong is paying the most, more than $11 per gallon for gasoline. Europe has the issue of that's even worse than here in the US with this energy crisis, because they're also paying nosebleed prices for natural gas. And now Russia is tightening the screws on supplies into some European countries. The feeling is that what analysts have told me is that as you see these energy prices high in other parts of the world, you may see other parts of the world first go into a recession, if we are talking about recessions here, before the U.S., and particularly Europe, because of these really high energy prices.
Well, if anything, Inez, I think that chart just reminded me, should we get some form of hurricane and that pressure is oil, we might be seeing Norway-like prices here. But look, gas prices have come down a bit, though, recently.
Yeah, they have. Here in the U.S., we are seeing the national average for gasoline now at $5 per gallon. A couple of days ago, it was at $5.02 a gallon, so down 2 cents. Some analysts are saying that in the next few days, you could see it come down even more, maybe slip around 5 cents or so in the next few days. And part of that has to do with gasoline futures that are lower. But look, if you take a look at diesel prices are still at all-time highs. And as far as supply is concerned, diesel is the shortest supply of refined products around the world. And diesel is heavily used here in the U.S., in Europe, in Asia, all over the world. So you are still seeing very high prices for energy.
I'll be right back. I'm going to go fill up my cart. Down 2 cents. That's great. See you guys later. No, all right, that's great. Thanks so much. That's not bad, though. 2 cents. All right, before we head to break, I want to highlight a big call on bank and card stocks by Baird. Baird analyst David Jordan says a buying opportunity has formed in shares of American Express, Capital One, Fifth Third, and M&T Bank. Says George, relentless panic selling has provided an opportunity for investors, with the risk reward finally looking attractive for banks and car names. George adds he believes the valuations on these stocks reflect more than enough macroeconomic risk. Coming up, as SnapShares sinks, even Evan Spiegel and company want you to pay up. The details on the company's subscription service straight ahead.
Welcome back, everyone. Celsius is taking heat as regulators across several states open investigations into the crypto lender's decision to suspend
Challenges and opportunities for Black-owned businesses with Liz Rogers, Creamalicious Ice Cream founder, president, and executive chef. And the tightest job market in decades is showing signs of loosening amid layoffs and hiring freezes, and of course ahead of a potential economic slowdown. But along with post-COVID consumer trends, the definition of business casual is changing. 60% of people surveyed by Mizzen & Main are shopping for work clothing at an athletic retailer. Mizzen & Main's founder Kevin Lavelle will join us to discuss those trends. I'm Rochelle Cooper along with Shauna Smith and Dave Briggs.
Hey there, Rochelle. Let's take a look at the markets here because we're seeing some buying action after what has been a pretty painful week here across the board. All three of the major averages in the green right now as we head into the final hour of trading. We're seeing leadership from the tech-heavy Nasdaq. The Nasdaq up nearly 2%. Emily McCormick has a closer look at some of these movers. Emily.
Well, Shauna, stocks are attempting a bit of a rebound this Friday, and I do say a bit since we are still on track for steep weekly losses. Now, if we head right over to the Yahoo Finance Interactive, you can see the S&P 500 up about 0.7% on an intraday basis, although, again, if we take a look over the past 5 days, still down by about 5%. So that is going to be the weekly loss we're looking for if these levels hold into the final hour of trading. Now, I do want to highlight one move that we're seeing outside of stocks, and that's in energy prices, and specifically energy commodities like crude oil prices. Now, West Texas Intermediate crude oil actually fell below $109 a barrel at its intraday lows today. That is about the lowest level that we've seen over the past month now. So seeing some of these energy commodities as well as energy stocks moving lower as these recession concerns continue to be a hot topic right now in markets. Now, I do want to highlight what we're seeing in terms of the sector action inside of the S&P 500. Again, seeing the energy sector leading the way lower, down about 4.4% on an an intraday basis. Whereas on the flip side, we do have communication services as well as consumer discretionary and information technology leading to the upside. So these tech stocks are attempting quite the rebound during today's session. Now, similar picture when we take a look inside the Nasdaq 100, quite the opposite from what we saw yesterday. Now, a majority of these names are in positive territory, led by many of those mega cap tech and growth names, such as Apple and Amazon. And then finally, I want to give a quick overview of what we're seeing in the U.S. listed Chinese stocks as well. Again, quite a bit of improvement there compared to what we saw yesterday, and also seeing Alibaba especially moving higher by about 2.5%. And that's coming after a Reuters report this morning that Ant Group, which Alibaba holds a stake in, is reportedly set to receive approval from the People's Bank of China to set up a financial holding company. So whether you're looking at domestic equities or international stocks, seeing a bit of a rebound being staged here at the end of this week, guys.
Fantastic. Emily McCormick, appreciate that so much. Enjoy the weekend. For more on the markets, let's bring in Joel Schulman, ER Shares CEO. Joel, good to see you. It's been a wild ride the last couple of days. Let's kind of step back and take it all in from the Fed announcement, skyrocketing there quickly, hammered yesterday, and then a bit of a bounce back today. Where are we big picture?
Big picture, I think we're going to be bouncing around, as you said, the last few days we went up. Same news, went up on Wednesday, down Thursday, big, up again on Friday. News really didn't change. The paradigm didn't really change. I mean, we're trading within ranges. And if you go back over the last month or so, you'll see that we're trading within, 5 to 10%, band. I see this continuing through the rest of the year. What's interesting is that many of the great growth stocks, particularly those that have had big losses, are down 70, 80% of the ones rebounding the strongest today. Also the ones that got hit hard yesterday. So we're seeing very strong results, in some cases up more than 10% from some of the higher, more speculative stocks today.
Joel, do you expect that momentum to continue in some of those names that had been beaten down for so long?
Yeah, well, it's interesting. If your listeners look at stocks like Walmart, Target, and even Coca-Cola, you go back over the last 30, 40 years, they were pretty much flat. And then from COVID on, for the last 2 years, they went up 200-300% in the case of Coca-Cola, right? Growth isn't there. So when you look at adjusted for growth and you compare it to a tech company like NVIDIA, which is known to have a very high relative price earnings multiple, adjusted for growth, NVIDIA is actually 1/3 the cost of a Target, a Walmart, or a Coke. So what's happened is a lot of people have moved money into staples in the indices, pushed the prices up. And now the so-called value stocks are actually, in my opinion, overpriced.
Then as we're seeing this aftermath from the Fed announcement and the market still trying to find their feet, how should people be positioning themselves right now?
That's a great question. We're looking at stocks globally. So we look at 56,000 plus companies globally. What we search for are companies that are able to contain costs, that have pricing. You hear a lot about this lately. Do they have pricing pressure? Can they hold off and keep their margins constant? There's only about 250 companies that we track that are profitable, that have actually reduced the sales and general administrative expenses, the SG&A. And there's a handful of companies that are reducing the costs on a relative basis, increasing the gross margin, and widening the bottom line, which is EBIT, earnings before interest and taxes. Now, those are companies that we look for. In many cases, have been bid up, but if you can find there's some hidden gems off the beaten track where they're actually able to keep their margins intact, and we think those are the best places to look right now.
All right, so let's talk tech. A nice bounce back for the Nasdaq today, up about 2%, but down almost 31% year to date. Joel, you say the brave investor invests in tech at this point. Yeah. But is there an opportunity?
I think it is. I think there is an opportunity. And you have to look at some of these things over the long haul. And tech has been such a strong performer in the last 15, 20 years. I mean, since the 08, 09 crash, we had, very strong, exceptional performance. Growth was the dominant leader. In the last year and a half, high growth tech and high growth stocks in particular have been beaten up quite a bit. We think they still have great growth on a relative basis. We think if investors are looking at a horizon a year plus out, they're going to be rewarded with tech. I mean, at the end of the day, people want to see growth. Now, what they don't want to see is growth at any cost, right? And that's what would happen last year. We saw, some cases price earning multiples over, in fact, multiples to revenue over 100. So market cap to revenue is over 100, which is very high. But we've seen valuations come way down, and we think tech over the next year plus is going to be well received, rewarded very well.
Joel, how much of the Fed's tightening plans do you think has already been priced into the market?
I think a lot of it's been priced in. I mean, when you look at the mortgages, and that's been a big story over the last week, and mortgages came close to doubling. They went from 3% to 6% recently. What that means is the individual who's buying a $500,000 house at the beginning of the year, same mortgage payment, can now only pay $350. So it's come down almost a third for the individual. So that's kind of brought things down. Now, what's happened is the mortgages went up by almost 3%. We have not seen that on a similar length of maturity for the federal bond, the long bond, so-called long bond, the 30-year maturity in the federal bonds has not gone up 3%. It's only gone up about 1 to 1.5%. We think that's going to continue to rise. We see 10-year, 30-year rates going above 4% by year end. So we're going to continue to see, some pressures on high growth stocks because people tend to view those, as being inversely related. We think, they've been unfairly beaten up. We see some of the growth coming back. Much of it's been priced in, but we're going to continue to see rates rise through the end of the year.
And in this discussion about whether or not the Fed can have that soft landing versus having the country go into a recession, you say the unemployment rate is going to be key to watch. What are you keeping an eye on there?
Well, what's interesting, when you look at COVID and came down from 157 million jobs to 147 million, and then it's bounced back up. What's really interesting, that the narrative that a lot of people aren't focusing on is we have 75 million baby boomers. These people, it's a big chunk going through our system. And pre-COVID, about 1 million per year were retiring. Last year, 3 million retired. And now what we're seeing, because of inflation, some of these and by the way, because they're retiring, it creates openings for more people to come into the workforce, and it's kept our unemployment levels low. Now when we have inflation so high, many of these baby boomers who are now afraid to retire early are delaying retirement. So what that's going to do is put increasing pressure on our unemployment level. So we see the employment, which has been the only bright spot in our economic situation, is that we've had high levels of employment to absorb some of these high cost increases and so forth. If we start seeing inflation, continuing to stay high, and then unemployment going up, we could see our economy, really come to a sudden halt. And we're already seeing, some of the leading indicators like building permits, of course, the bear market, the markets hit fell below 20%. That's a leading indicator. We're seeing sentiment down. So we're already seeing some leading indicators pointing to a recession. The only thing that's kept us above water are the low levels of unemployment. If the boomers delay retirement, and some of the tech companies which have weak cash flows and losing money, and they don't get refinanced, and they start laying off more and more, we're going to see this economy, come to a sudden halt very quickly. And that's the big fear, that we won't have a soft landing, that we're going to go into a tough period of time.
Yeah, and we had 60% of 750 CEOs say they do think in the next 12 to 18 months we'll have a recession. Didn't hear if you are among those, and if so, is it this year or next?
I don't think it's going to be this year. I think if we have, it's going to be 2023. I'm hopeful that things will continue to work out fine, and that inflation is peaking. We're certainly not getting any help on the energy side. Food prices continue to remain elevated. These are concerns. And again, wages, which are sticky, they don't drop that quickly. What tends to happen, wages generally don't go down until we have an economic recession. And so I hope that's not the case. But we didn't get into this mess overnight. We're not going to get out of the mess overnight either. And I think that's the problem here, that a lot of people were encouraging the Fed to increase rates more and more, go from 50 to 75 basis points to try and get this inflation under control quickly. We've got to remember, this problem did not happen overnight. It was trillions of dollars feeding into the economy over a period of 2 years, and it takes some time to unwind.
Joel Schulman, thanks so much for joining us, CEO of ER Shares. Have a great weekend. Well, speaking of fears of a recession fears surging among top business leaders. You just heard Dave say 60% of CEOs now expect a recession in the next 12 to 18 months. We'll break down exactly what this means for the Biden presidency and also for you when we come back. Recession fears surging among top business leaders. A new survey from the Conference Board found that more than 60% of CEOs expect a recession in the next 12 to 18 months. That's compared to just 22% at the start of the year. Rick Newman is here with us. And Rick, we talk about the fact that the Biden administration obviously facing a huge challenge when it comes to inflation. Now more business leaders are sounding the alarm on possible recession. It can't be what they want to hear.
That's right. And it brings to mind Jamie Dimon, the CEO of JP Morgan Chase, saying recently he sees a hurricane that might be coming. I do want to make one point about that survey, however, which was from the Conference Board. Those were global CEOs. That was not just people running U.S. companies. That was people running some U.S. companies, but also companies in Europe and Asia and other parts of the world. And other countries are in worse shape than we are. Biden keeps saying that, and he's right, especially Europe, which is dealing with a lot more difficulty from the Russia-Ukraine war than we are here in the United States. They are much more dependent on Russian energy, and they're having a much harder time dealing with some of that Russian energy that's getting cut off. So Europe may already be in a recession. That does not mean we're going to go into a recession here. I just don't want us to become a little too promiscuous, going around saying, oh, a recession is coming, a recession is coming. The unemployment rate is still 3.6%, I think. That's extremely low. So we're not there yet, and let's not talk ourselves into it.
I think you raise a fair point. I know we spoke about this before, sort of speaking a recession into an existence and then that affecting sort of mood among CEOs and other things. But when you keep in mind that this many CEOs are thinking like this, and we're already seeing some layoffs in the tech sector, could you think that end up having more of a tightening in the labor market if CEOs are becoming more pessimistic?
Yes, but there's another side to this, which is these sort of warning signs that we're talking about. This is exactly what the Federal Reserve is trying to do. They are trying to cool off the economy. That means cool off the labor force. If you make people a little more conscientious about spending money, that is exactly what the Fed is trying to do. They are trying to reduce demand for all these things that have been going up in price so much. So yes, these are, on one respect, these are typical warning signs of a slowing economy, but it's also exactly what the Federal Reserve is trying to do. When you hear it's bad news for Target's earnings that they have too much inventory and they're going to have to start having clearance sales, but that means inflation is going to come down, at least in those products. So this is what the Fed is trying to do. And, this gets back to the central question for the Fed is, will they go too far or will they get it just about right?
And I hate to keep talking about the R word, recession, but President Biden was asked about it by the AP and said a recession is not inevitable, but a couple of key caveats, and one being that he said most of what happened is a consequence of COVID, and two, that the United States is better positioned than anyone in the world to get through this without a recession. Are those true statements?
I think they are. And I'm sure that, possibly some tiny place like Luxembourg might be in a better position, or Switzerland, where they depend on, banking for the world's elite. But among large developed economies, we have the best labor situation. We are dealing with the Russian invasion of Ukraine and the resulting increases in energy products. That is a global market, and you can't escape that. But here in the United States, we also have more domestic energy production, which Europe does not have, and that's a good thing. Now, Biden, of course, wants oil and natural gas drillers to produce even more than they are drilling, but we probably are going to get to record levels of oil and natural gas production here in the United States. So it's not a comfort to people to say, the economy kind of sucks here right now, but it sucks worse someplace else. That doesn't make anybody feel good. But it's, look at the data, and it's more or less true.
And Rick, it's also causing some tension within the Democratic Party, right? Because some Democrats are a little bit frustrated that Biden hasn't been changing his strategy or changing the messaging when it comes to the pressure that the country is under with inflation.
Right. There's now some grumbling coming out of Capitol Hill among Democrats who are saying, look, this situation has completely changed from 6 months ago when Biden was still trying to get his Build Back Better legislation through. And basically what the White House has done is just a rebranding exercise. Now they're saying, we need to pass help families with child care because that will help beat inflation. That will lower the cost of child care for families. So it's the same program with a different branding attached to it. And, some Democrats on Capitol Hill are starting to say, we need a new plan, man. The problem is there's just not much the president or Congress can do about inflation. This is up to the Federal Reserve to fix it. Biden has said that, and he's just in a crappy political position right now, which is why his approval rating is, last I saw, it was at 39%, the lowest of his presidency so far. And I suppose it could probably go lower than that.
Yeah, said Ro Khanna, needs to be more imagination, more energy, more boldness, not a terrific review of their economic plan. Rick, good to see you. Happy Father's Day. Thanks.
Thanks, man. See you guys.
All right, ahead, Bitcoin prices extending their slide, now on the verge of breaking below $20,000. We'll get a look at the week that was, and it was a wild one in the crypto space. We'll have that for you after a short break.
We've got 37 minutes to go here until the closing bell. We're looking at some buying action. This market check is sponsored by Tastyworks. Dow up just over 100 points. S&P holding on to gains, and Nasdaq has been the outperformer today. It's still outperforming here in the final half hour or so of trading, up just around 186. Taking a look at the sector action today, communication services, consumer discretionary, technology, some of the sectors that have been beaten down pretty severely at the start of the week, seeing a bit of a bounce back. Energy, the worst performer. That's been the case all week, with energy off just around 4.5%. That's the XLE. Well, taking a look at crypto, it's been a brutal week for crypto as well. The sell-off in Bitcoin bringing the price to just above 20,000. And S4A has a closer look at the selling pressure for S&S.
That's right, Shauna. It has been a rough week for crypto asset holders. If you were in Bitcoin over the last 7 days, you saw Bitcoin going lower. A couple of headlines this week that really caused a lot of this action. One being Celsius, the crypto lender, which announced that it was restricting Bitcoin withdrawals, swaps, and transfers. Then you had Coinbase, that the platform which announced a layoff of 18% of its employees, with CEO Brian Armstrong talking about a recession recession and crypto winter. And then in the backdrop of this, of course, you had Bitcoin that has been falling. So this is a 10-day chart. Remember that Bitcoin trades through Saturday and Sundays as well. Over the last 10 days, losing 34% of its value. This week, the total global crypto market dipped below $1 trillion. So this idea of cryptocurrencies, of Bitcoin, of Ethereum being a hedge against inflation, not proven to be so. When the Fed tightens, all asset prices go down. Crypto has come down, guys.
Indeed, and how has it? Ines Ferrer there, thank you so much for that update. Well, crypto lender Babel Finance is halting withdrawals just days after Celsius did the same and sparked that crypto sell-off. More on crypto's wild week. We're joined by Matt Hogan, Bitwise's CIO. So, Matt, obviously a tough week here, but even though these are just the latest controversies, it didn't start here. How did we get to this point?
Oh, it's a great question. Thanks for having me on. You know, there is a macro trade from risk on to risk off assets that drove crypto prices down starting about November of last year. Crypto prices retraced down about 50%. And after that pullback, what we're seeing is sort of exposing the weaker corners of crypto, right? We saw Luna stablecoin fail. We saw Celsius run into issues. You mentioned Babel Finance. Crypto is going through a classic deleveraging cycle, and it has to continue that cycle until it hits the bottom. So again, a macro reset drove down prices, exposed some weaknesses, and now we're in the process of washing those weak corners out of the crypto market. We'll get to a bottom and rebuild from there, but we may not be at that bottom yet.
Which implies another rough week ahead. Bitcoin down 22% the last 5 days. We talked a lot about the last 5 days. Where do you think we're going in the next week or even two?
Yeah, I think the next few weeks could see continued volatility. I wouldn't be surprised to see a short-term bounce if we can get through this weekend unscathed. You know, trading volumes thin out a little over the weekend, and so you can get some extra volatility. There is a lot of institutional capital that wants to move into the market. We speak to financial advisors and family offices all the time. They're thinking about where the right point is to buy this dip. But my big picture view is there's still a lot of macro uncertainty in the market. There is still some questions about how much more deleveraging there is to go in crypto. So there's volatility, you know, for the next few weeks, next few months. I do think the long-term aspect's still bright. The fundamentals of crypto underneath these macro news items is still very strong, but there is continued volatility on the horizon, at least for the next few weeks and probably for the next couple of months.
Yeah, Matt, there's been lots of talk out there about what could potentially be the next shoe to drop. Is there anything in particular that you're watching or investors should be watching when it comes to the expected volatility that we could see in crypto?
Yeah, you know, I'll tell you something interesting, which is at the first start of this week, everyone felt there were multiple shoes to drop, and we did see some more drop. Also not mentioned, Three Arrows, a large hedge fund, is imploding, right, is winding down over the course of this week. Now there's a more diverse viewpoint. Many people think there is not a next shoe to drop, but others are looking at other lending platforms or other hedge funds and wondering if there is more. It is a start of a sentiment shift, but I still think there is risk. There could be additional repercussions. You know, deleveraging processes always go on a little bit longer than you think. They have to get to a very solid foundation before you can build. And I think there is a worry that there may still be a few more items along the lines of Celsius and Babel and Three Arrows yet to come.
And Matt, as you mentioned, some of these corners of crypto now getting sort of thrashed out as we see there. But are there some aspects of the crypto industry that are doing well? A lot of focus on the individual tokens and the platforms themselves. What about the underlying technology and those sectors as well?
Yeah, I think that's really important. If you're a long-term investor, this is one of the most exciting times to enter the crypto market. You're getting to enter into, you know, world-class market-leading protocols at prices that are down 70, 80, and 90%. When we look at what's going on in the Ethereum ecosystem, or we look at some of the decentralized finance applications like Uniswap, those are amazing market-leading technologies. They're making continued progress. They're onboarding users. Their trading volumes are significant, and their prices are down substantially. So I do think there is a buying opportunity if your window is not the next 3 weeks, but the next 3 years. You're really having a sort of rare opportunity to enter these market-leading protocols at prices that are down 80 or 90%. But you do have to have that long-term point of view if you're going to do that.
So you talk about the next 3 years, but the next 3 months are going to be interesting. And we heard Jerome Powell talk about at least another 50, if not 75-point hike in July. We're certainly going to have another hike in September. And what does that mean for the crypto space to continue to raise rates in the short term? How will it? Yeah.
It's a great question. I think the market is comfortable with those rate hikes. I would say that those rate hikes are already priced in to the crypto ecosystem. The question is, does Powell have to go further than that, right? If we start seeing the market pricing in not 75 basis points, but 100 basis points at the next meeting, that could be difficult for risk assets. If we start to talk about Fed funds rate, going into the 4s and 5s over the long term, if it's harder to quash inflation than we're currently thinking, that could be hard. I do think 75 basis points at the next meeting is already priced in. Probably 75 basis points at the next meeting is priced in. The question is that enough, or will there necessarily be more? And there are obviously diverse views on that.
Indeed. Well, we do thank you for joining us today. Matt Hogan there, CIO of Bitwise. Well, after running into complications over its COVID vaccine side effects, AstraZeneca reportedly putting in a bid for a biopharma company. We'll have the details just ahead on Triple Play. Welcome back, everyone. It is time for our Triple Play, and I'm kicking us off with my pick, which is Mereo Biopharma. Now, the stock was actually popping today on an article in the Times that says AstraZeneca is putting in a bid for the company. As you can see there, the stock up 73% there, and AstraZeneca also getting a slight boost as well. Now, Mereo is a London-based US-listed company that specializes in therapies tied to cancer and orphan diseases. Now, these are the diseases designated by the FDA as deadly, but so rare that they struggle commercially, so they receive special financial benefits for developing safe and effective drugs. Mereo's stock, though, down more than 70% over the past year.
Yeah, Rochelle, we've been seeing AstraZeneca trying to expand its business. Mereo might be the right fit for the company. We know that they already have a partnership with Mereo, so they're very familiar with the brand. They aren't the only possible bidder here. In that report, it did mention that there might be some interest from other big players, notably Novartis is on that list. So it's far from a done deal. We'll have to see how that all shakes out. Let's take a look at the travel industry because my play is Carnival. Now, that is because of its partnership with BetMGM and its move into sports betting. It will now offer mobile wagering on more than 50 ships. Now, those ships included in this are Holland America, Princess, and Carnival lines. Travelers will be able to bet on sports and online games from their phone or laptop. Now, BetMGM will also offer betting in kiosks on just some of those ships. Dave, it's going to be interesting whether or not this will actually entice some travelers, some cruise goers back onto the ships because the sector has really been struggling. The cruise lines aren't exactly seeing the interest that they were hoping to see because people simply are scared to get on them because of COVID.
Yeah, I think it's a great move. Will it get people back to pre-19, pre-COVID levels? I just can't imagine. All three big North American cruise stocks are down 50+% on the year. And people just tell you anecdotally, demand is still down because people have that fear built in on COVID and quarantines and ships being stuck. It's going to take a lot longer than the airlines to rebound. Hopefully this helps. All right, my play is Devon Energy. Needless to say, the sector has been among the biggest winners this year, given the soaring global oil and gas prices. However, 4 of the 5 biggest losers on the S&P today, all oil and gas companies, and Devon leads the way in that. The energy sector only makes up about 5% of the overall S&P, but as of this morning, those stocks are up 39% in 2022. That's easily the best performing sector. But today, again, nobody down more than Devon Energy at the moment, down just below 8%. But it is all relative for them, still up 27% year to date. Will we see some demand destruction at these gas prices? We have seen $5 stay static for about the last 5 days. Will the president and the energy secretary have any success, Rochelle, in increasing supply? That is clearly what they're trying to do here, is get the refining capacity up. That is a tall task.
I mean, it's tough. I mean, you're hearing from oil producers that they just don't have enough supply to meet demand. We saw the International Energy Agency predicting that oil supply will still be struggling to meet demand in 2023, and that global demand will actually surge to 101.6 million barrels a day. And that's even if prices stay elevated. And of course, you have the world's biggest crude importer, China, coming back online. And if their demand picks up, that means oil is going to be under even more pressure.
Yeah, there aren't any signs of demand destruction just yet. But Dave, you bring up a good question as to when will we possibly see that? There's been calls that oil will likely go, or gas, I should say, gas prices should go above $6 or could go above $6 a gallon. You have to start thinking at that point we could see some demand destruction. But energy has by far been the winner this year. We've asked guest upon guest upon guest whether or not they still see further gains for the energy sector. And most of them say yes. It's not a sector that you want to bet against at this point. So there certainly is a lot of questions out there just in terms of supply. But prices, it's going to be so crucial to watch.
I think we're awfully close to demand destruction. Yeah. I'm curious, the two of you, if you've seen it. I've heard a lot of people tell me they are making a conscious effort to drive less. I'm hearing people, when they talk about new jobs, push for at least a hybrid model because they are factoring in $115 to fill their SUVs right now, and that's most of the cars that I see on the roads right now. Look, I think we are at that point, and why is $5 stuck for the last 5 days? It feels like we're awfully close to that point.
I mean, you think so, but at the end of the day, not everyone has the luxury of being able to work from home. Yeah. Sometimes it's a must. It's not a luxury. You still have to drive. So it'll be interesting to see how much demand destruction will kick in, because only certain people can really afford to stay home or perhaps even ask to perhaps work from home. It's not the case for everybody. So people are really still in a tough position.
And especially right now, we're in the summer months. We know that's a very heavy travel season. A lot of people are taking road trips, especially at a time when airfare has soared like it has over the past couple of months. So maybe people will start adjusting their plans. Maybe they'll go 30 minutes to an hour away instead of making that 3 to 4 hour trip. But certainly is something to watch and affecting all of our users or all of our viewers. Right?
To your point, I think a lot of people are saying, hey, I'm still going to take that road trip because compared to airfares, a couple tanks of gas feels more tolerable right now given the prices. All right, so coming up, how tone-deaf corporations are facing backlash for Juneteenth-themed products. Stick around.
Major retailers facing backlash for their attempts to monetize Juneteenth. Now, Walmart is one of those brands recently apologizing after putting a new red velvet ice cream flavor called Juneteenth onto their store shelves. Now, critics took to Twitter very upset that Walmart was doing this and urging customers to support Creamalicious instead. This is a Black-owned business that had its own version of red velvet ice cream. Well, we want to welcome in the founder of Creamalicious to the program, Liz Rogers. Liz, thanks so much for joining us.
Thank you for having me.
So Creamalicious has certainly been getting a lot of attention over the last couple of weeks. What's it been like for your brand and the exposure that you've seen because of this controversy with Walmart?
It's been super exciting. We've had a ton of support. I'm just really been really excited about just the brand in general, just expanding and just meeting all of the Creamalicious fans across the country. It's been extremely inspiring, and it's been an amazing brand awareness, to say the least.
And obviously, this can be a tough space to navigate when you're already in a store and then they're having this controversy. Talk about your decision in terms of the way that you handled it and really the message that you want to give to perhaps some of these other Black entrepreneurs who would like to see their things on national retailers' shelf.
Well, there was a huge, just overnight, just keeping up with the demand because the product was in demand really, really fast. So there was really no way to prepare for that. But at the same time, it really gave me a lot of insights on the business, how to expand the business, and different things of how to navigate through the business. And what I would say is this, you know, as entrepreneurs really need to make sure that they have an amazing team behind them that can help them, because you can't do everything by yourself. You really need to understand your vision. You need to understand what your product is, the demand, and make sure you have a really good supply chain as well.
Applaud you, Liz, for not being upset. I'm a little upset with you that you didn't give us some banana pudding or peach cobbler ice cream. So next time, please, those are two flavors high on my list. But I'm curious about, you have said that you did not want, and still do not, want retailers to consider the color of your skin, to bring you into their stores because of diversity. Why? And what do you think about the 15% pledge, which is asking businesses to require 15% of their shelf space to Black-owned business owners?
You know, cheers to the underdog. You know, Creamalicious, you know, I'm the underdog. I'm right there next to Ben & Jerry's and Nestle and Haagen-Dazs. These brands are giants. Just growing up, I looked up to these brands. They have really great staying powers and they have a huge machine behind them. So what I try to do is I don't compete with the bigger brands. I created my own dessert category. Creamalicious is the only 2-in-1 dessert on the market. It's chef-inspired, Southern-inspired, and it's an artisan brand. It has amazing brand stories. It's more of an experience than a dessert. So, you know, it's very authentic. You know, it's a great product. You know, are we perfect? No. You know, we're brand new. We're doing extremely well, and we're trying to hone in and craft, just perfect our brand, you know. But at the same time, we should look at that piece of it. And by the way, I'm an African-American, proudly African-American owned woman brand. So we shouldn't lead with that because I don't think any brand's leading with the color of their skin.
And what do you think about the 15% pledge? Do you like that?
I do like the 15% pledge because, you know, there has not been an African-American in mass production as it relates to ice cream that's national. In the masses. We do have African-American owned ice cream manufacturers that are regional, but I'd like to see more of that. I do feel like, you know, we do have the opportunity to go into the retailers, but we do need resources to stay and sustain the brand. You know, there needs to be resources allocated to smaller businesses to make sure that it needs to be an even playing scale.
And I want to ask you, because obviously these recipes passed down through generations to now, what have been the biggest lessons that you've learned in going from sort of having these recipes to getting them actually onto the shelves of national retailers?
Well, I work with some of the top food scientists in the country. I really wanted to make sure that I own my own IP, my intellectual properties and formulas. So I work with food scientists to help me hone in on what it meant to scale the brand. I am not a private label person. I've done a lot of private labeling for proprietary brands for their proprietary pints. I just did something really big with McAllister's. That's an amazing national brand with their iced tea. They're super famous for their iced tea. And that was a really cool situation for me because I got an opportunity to really taste their iced tea, make the ice cream with the iced tea flavors and components, and really bring a 2-in-1 dessert to market. So that was a really big learning experience for me, and I'm doing a lot more of that.
Liz, you mentioned the importance of resources to sustain a brand. I'm curious, what are those resources? What's necessary to sustain a brand from your view?
You have to have very good attorneys, regardless if you can afford them or not, very good CFOs, accounting. You have to have a very good marketing and branding team. And you really have to have people around you that are brilliant, that know a whole lot more than you. I was, you know, really smart enough to know, just having other businesses and learning a lot of lessons, success and failures, but not necessarily living in my lessons, that I'm more of a creative person. I'm an artist. So my team allows me to stay in a creative space, be the executive chef of my brand, and just create. I'm kind of like a Willy Wonka kind of person. So Creamalicious is extremely innovative. We're very agile. We can make fast moves. So, you know, when things come about, an opportunity set is for Creamalicious, we're able to move on things a lot quicker without having to go through so much red tape.
Speaking of moving quicker, Liz, Monday we'll honor Juneteenth, the end of slavery. It's only been a year. It's astounding that President Biden first signed that just a year ago. What's your message to the 30 states that don't recognize it and the corporations that don't yet recognize it as a paid federal holiday?
We do need to recognize it because it is something that has come a long way in history. You know, that these are unprecedented times. You know, it's just with ice cream, you know, for me, ice cream is supposed to make people feel good. Change and just progression should make everyone feel good. I mean, we're not all that different. We're all human. We should recognize the pain. We should recognize history. We should recognize the lessons and just how just the country and African Americans in general, we've just come a long way. And I'm sure there's other races and other business owners, and there's so many different things that has happened in the world. And I think everyone should recognize the good.
Yeah, certainly very important for everyone to recognize Juneteenth. Liz Rogers, thanks so much for taking the time to join us. Creamalicious Ice Cream founder, president, and executive chef.
All right, from ice cream to coffee, more leadership changes coming to Starbucks. The head of the coffee giant's North American business leaving the company after working her way up over the past 17 years. Roseanne Williams has been one of the company's point people to respond to the growing unionization efforts among Starbucks baristas nationwide. The move coming as founder and interim CEO Howard Schultz reshapes the company's executive ranks. Starbucks shares trading higher, just up over 1%. Coming up, a letter that criticized SpaceX chief executive Elon Musk did not end well for some employees. We'll bring you that story after the break. All right, it's that time. It's time for our Musk Minute. Elon's SpaceX fired at least 5 employees after it found they drafted and circulated a letter criticizing their founder and urging execs to make the company more inclusive. Yahoo Finance's Dan Howley here with more. Dan, it appears that the rule for Elon is do as I say, not as I do.
That's right. Yes, these employees were fired after this letter came out. This is according to the New York Times. Basically, the president of SpaceX released a statement to employees, not externally, but saying that some other employees felt bullied and intimidated by this letter and called it overreaching activism. Now, the letter was calling for basically Elon Musk's kind of behavior to be separated from the company itself, or for the company to kind of push back against his behavior. That includes political content comments that he makes on Twitter, as well as his general sharing of memes and different juvenile activities that he does on the social network, and keep them away from SpaceX, which is supposed to be a rocket company run by the guy that is sending things to the International Space Station. When you're doing something like that, a critically important endeavor, you would think that you would try to, not post ridiculous memes or, compare democratic leaders in the world to fascists. So obviously, Elon Musk, though, not happy with that, or at least SpaceX not happy with that. Now, the kind of wrinkle here is that Elon Musk has talked about being a free speech absolutist as far as Twitter goes, but this obviously seems to go against that thinking.
And speaking of social media companies, I wanted to ask you about what's been happening with LinkedIn and these allegations of fraud on the platform. What's going on there?
Yeah, this is basically another issue with cryptocurrency scams. Apparently, they were being run on LinkedIn. People would be suckered into investing in legitimate cryptocurrency exchanges, and then fraudsters would ask them to move all of their currency to a different exchange, and they would steal their money. Cryptocurrency scams are relatively common, unfortunately, on social media. So, if you're a regular user, if someone reaches out to you ever for any kind of proposition to make more money, just ignore them.
All right, Yahoo Finance's Dan Howley. Good to see you. Good information. Thank you, my friend. Enjoy the weekend. Coming up, we're counting down to the closing bell on Wall Street. Where will this wild week take us? The answer next on Yahoo Finance Live.
Just a few minutes away from the closing bell, we're seeing the Dow really hyper oscillating into those last minutes into the close there. So let's take a deeper dive with our very own Ines Ferre. Ines?
Rochelle, and the Nasdaq is the outperformer today, up more than 1.5% in this final minute of trading. But really, for the week, all the major averages going to end the session or the week in the red, with the Dow down more than 4.5% for the week, the Nasdaq Composite also 4.5% lower at least, and the S&P 500 down more than 5.5%. In fact, the S&P 500 set to close at its lowest level since January of 2021. Looking at the sectors for the day, we are seeing that communication services, consumer discretionary technology, those have been the leaders today. We've been watching energy today really lagging. And over the last 5 days, in fact, I'm going to pull up that 5-day chart. You can see that energy, which has been the outperformer for the year, this week has been the underperformer. Looking at the Dow, where we're going to end the day, a mixed picture, but for the last 5 days, well, all the components of the Dow, except for Boeing. Boeing will end the week in the green, but all the rest will be ending in the red. Taking a look also at the Nasdaq 100, you can see the big cap names over on the left-hand side of the screen. Amazon up more than 2%, but for a 5-day chart, you can see a lot of these underwater. The semis for the last 5 days also underwater. A lot of pressure on these stocks this week. And the travel stocks today seeing green, but for the last 5 days, they've been underwater. Here's the closing bell for today, Friday, June 17th at the New York Stock Exchange.
That was the closing bell sponsored by Tastyworks. And taking a look at where we ended today, you can certainly see we lost some steam in the final couple minutes of trading. The Dow closing off just around 42 points. The biggest laggards in the Dow today, Chevron off just around 5%. Walmart and Goldman, both of those stocks off nearly 2%. Taking a look at the losses in Chevron, you can see that reflected in the broader energy sector. The XLE, like Ines was just telling us, off just around 5% today, off 17% for the week. Nasdaq off 4.5% for the week. S&P having its worst week that we have seen since at least January 2021. Well, let's talk about the moves that we've seen over the past 5 days and what we could expect going forward. We have Ann Berry, Threadneedle Ventures founder, and we also have Kevin Mon, Henny & Walsh, Chief Investment Officer. And first to you, because we're trying to make sense of the volatility that we saw, the intense selling. We did see some buying action earlier today. What's your big takeaway from the massive losses that we saw this week?
Yeah, there's just no place to hide at this point. And that's actually really unusual. Normally you'd expect to see certain sectors performing better than others, depending on what kind of down cycle you think you're in, and you're just not seeing it. Everything is down, and I think it's going to be that way for a while.
And Kevin, the same to you. Big picture, last 48 hours or so, your takeaway. You know it's bad when energy is down 5+% for the week.
I think investors are still trying to understand and grasp exactly how aggressive the Fed turned earlier this week. Not only did they raise by 75 basis points after telling you just 5 weeks earlier that raises above 50 basis points weren't even consideration, but they also raised the consensus for their year-end Fed funds target rate from 1.9 to 3.4%. They're going to be raising rates aggressively into a slowing economy that in all likelihood will be in a recession soon.
So given that we're in this period right now, and Anne, you said there really aren't any places to hide, how should people be positioning their portfolios right now? Is it better to hold on to cash, or is there something to start making your shopping list with?
Credit is something I'm starting to look at very aggressively. There are ETFs out there, there are publicly traded funds that help you find ways to try and find yield in very liquid instruments. Things like AAA, that's an example of an ETF. There are others out there. So rather than just holding cash and having it in the bank account, that's the kind of place I'm looking to try and wait this out right now.
Kevin, what do you think? Where are you seeing opportunity?
Well, investors can't reinvest for what's already happened in 2022, but what they can do is invest for the balance of this year and into next year as well. We did a couple research studies here at Smart Trust, and what we found is that during periods of rising rates, certain sectors tend to outperform. We then mixed in slowing economic environments that lead into recessions. 2 sectors jumped off the screens that came across in both of those studies, those sectors being industrials and, believe it or not, information technology. If you factor in an ultimate recession, then you add utilities. So investors are looking to position themselves for the next 1, 2 to 3 years. You may want to look at quality companies that pay dividends and are associated with those sectors.
And what do you think of that? Information technology and industrials, are those built to sustain the next 12 to 18 months?
Well, I think industrials is one, and I think it really depends on how capital intensive those businesses are. So if you look at the industrial companies who need to spend a lot on machinery and equipment and real estate, rising rates are pretty tough for those businesses. So it depends on the capital intensity. Information technology, not all of these businesses are created equal. And I think one of the things Kevin said that was key, it's cash. Which of those businesses are generating cash? That's what I'm looking out for.
And Kevin, I want to ask you about obviously the crypto sell-off we saw. A lot of large institutional investors in this space. What's your take on whether it's worth having crypto in your portfolio right now?
I'm not a large or a small crypto investor. In fact, I can't put my arms around valuation. I couldn't tell you why it rose as much as it did, nor can I tell you now why it's fallen as much as it has. What I can tell you, though, in terms of one area of information technology, which I do think is transformative and which has sold off significantly, is blockchain. That underlying technology that cryptocurrency is based upon can also be found in other industries such as healthcare and financial services. So that's one area to potentially consider. And despite this significant sell-off we've seen thus far in 2022, there are many attractive valuations for different companies across many sectors. And here's one statistic that I'm going to give all of your watchers today, and that's the Altman Z statistic. That was developed back in 1968 by an NYU professor to help predict the probability of a company declaring bankruptcy over the next 2 years. Wow, isn't that appropriate for right now? So if you can find those companies that have good, strong balance sheets, cash on their balance sheets, pay a dividend, and an Altman Z statistics is below 3, that should help you navigate through what's likely to be some difficult economic times in the months ahead.
Speaking of the difficult times here, even over the next couple of weeks, and there's been lots of talk about PCE, there's been lots of talk about earnings, but we have a few weeks until we get PCE, and then, of course, until earnings season gets underway. What should investors be watching or focusing on until then?
Well, the frustration is right now we feel like we're flying blind to we're in this sort of information black hole period. I think it's looking internationally, actually. I don't think we talk enough about looking overseas. The UK right now, I think, is in technical recession. It's had 2 straight quarters of decline. Looking at the Chinese situation with continued lockdowns and seeing what Europe has to say about the impact of the Ukraine on their GDP growth. Until we have domestic data ready here, looking overseas to see what's going on, I think is important.
Yeah, Kevin, what about that? You got the news from the ECB and the Swiss bank, and it looks like situations are quickly worsening across Europe. Are they headed towards a recession, and what's the implication on our economy?
It's an excellent question. And inflation isn't just a U.S. problem. It's a global problem right now. And other central banks are trying to thread their own needles with respect to trying to dampen inflation without killing economic growth entirely. We saw just the other day the Swiss National Bank raise interest rates by 50 basis points and also indicate that they may look to start selling U.S. equities off their balance sheet. That happened around 4 o'clock in the morning the other day, and that's when we saw the future markets turn quite considerably. So I do think this is a problem that's shared across the entire globe. But again, that has created opportunities for investors to consider. And I agree with Ann, having some degree of international equities in a globally diversified portfolio should position investors very well coming out of what's likely to be a global recession over the course of the next year.
And speaking of that, Anne, obviously we saw the Conference Board come out with their data showing that 60% of CEOs expect a recession, 15% believe we're already in a recession. How do you think that is going to shape things like earnings going forward?
One of the issues with expectations is they can become self-fulfilling. And actually, if you look at the Fed, they were concerned about the issue that inflation expectations were becoming self-fulfilling. I think we're going to see that too. If CEOs are not confident, they're going to cut back on hiring, they're going to cut back on capital investment, they're going to cut back on marketing spend and other areas that typically get cut during recessionary periods. So I think the issue here is needing to see from the business community that there is a belief that there's a light at the end of the tunnel relatively quickly.
Okay, Ann Barry, great to have you in studio. Kevin, when are you going to come hang out?
Invite me and I'll be there.
Okay, buddy. We'll see you soon. Enjoy the weekend.
Have a great
meanwhile.
weekend, everybody.
Okay, you too. Coming up, a gallon of regular gas now costs $5 on average nationwide. But how high can these prices go? We'll break it down for you and when we might see some demand destruction ahead.
Lots to watch in the health space with FDA approval for COVID vaccines for children under 5. And now the Florida Department of Health is ordering doses, a reversal from what Governor DeSantis originally said. Let's break all of this down with Yahoo Finance's Anjali Kamlani. Anjali, what do we need to know about these updates?
Well, Rochelle, first of all, we definitely know that the good news is that the FDA did come down with that authorization this morning, and we're still waiting for the CDC to really okay those doses. But in the meantime, we got word that 49 out of the 50 states had pre-ordered doses, and Florida remained the single state not to order any doses for that 5 and under group. Now, what has been seen as a reversal is that the government has specifically said, the state government has specifically started to say that clinicians and other individuals who are eligible could order through the State Department, but the state itself was not putting in the order through the federal government. We heard from the Surgeon General yesterday saying something similar. And then today, a spokesperson for the governor did say, quote, the state of Florida does not recommend nor distribute shots for babies. Any healthcare provider that wants the vaccines can obtain them, and any parent who wants it for their child can get it. Now, that is basically putting the burden on pediatricians as well as pharmacies and hospitals. We know that CVS, Walgreens, and others that are partnered with the federal government to distribute those doses have been ready to do so in Florida, as well as the pediatricians and hospitals were ready to administer them. But it's unclear whether or not they knew that the burden was on them to do so. The Surgeon General saying yesterday that there were no orders yet through the state portal. So as of today, they should be coming in. Back to you.
All right, good news. Anjali, thanks so much. Turning now to gas prices, has the pain at the pump plateaued? Gas prices averaging an all-time high $5 a gallon, but have not increased in 5 straight days, even down fractionally today. Yahoo Finance Editor-in-Chief Andy Serwer is here with what's fueling the political shouting match. You see what I did there, Andy? That's why you hired me.
Oh,
fueling
the
political shouting match.
Yeah, nicely done.
I'm good.
Yeah.
So President Biden, how fixated is he on the price of gas, and what can he do about it?
Yeah, I mean, this has been a big issue this week, you guys, for President Biden. On Wednesday, he wrote big oil companies a letter jawboning them, saying it was essentially unpatriotic or not right to have high profit margins during wartime, even though it's not our war, while Americans are paying, $5 plus at the pump. Still, then on Thursday, yesterday, an interview with the AP, he said, this is the key issue, sitting around a dining room table where Americans talk about how well they're doing, which is pain at the pump. And, obviously it speaks to the midterm elections coming up and then even his own reelection down the road.
So Andy, I want to ask you, what position does this put the oil companies in, given, the 28 largest producers made close to $100 billion in combined profits in just the first 3 months of 2022? And we did have a guest say, look, it seems like President Biden is punishing us for doing well. So how are the oil companies responding?
Yeah, Rochelle, I mean, where are they? They're between a rock and a hard place. And, the real problem here that the oil companies are putting forth is that they've been jawboned heretofore by the administration to cut back on producing oil to transition to a non-fossil fuel economy, right? And so now all of a sudden they say, okay, these same guys are coming back to us and saying, hey, wait a minute, can you give us more gasoline? And, they're saying, well, wait a minute, just 2 months ago you were saying to stop doing the gasoline. And I guess they have a point, although, you have to say, okay, yeah, when the facts change, why don't you change what you're doing? And they sent back a letter to the president after he sent the oil companies a letter on Wednesday. The API, the American Petroleum Institute, sent a letter back refuting the president's position and offering a 10-point plan on how to make America more energy efficient and independent.
Well, Andy, you mentioned the fact that this has been a topic now. Everyone knows that they're paying more at the pump. People are talking about it at the dinner table. What can people do? Are there certain steps that they can take to help save some money on gas?
Yeah, I wrote about this, Sean, and I'm being a little bit flip, right? I mean, to be quite honest, a little bit trolly. One thing is drive less. Okay, it's like, I can't drive less. Well, we kind of take for granted in this country the right to have cheap gasoline, the right to drive so much. And we pay just so much less than countries in Europe. Hong Kong is like $11 a gallon. Europe's north of $7 a gallon. Number one. Number two, you look at the states where people pay the most for gasoline per income, and it's red states, it's poorer states, and the richer states, people spend less on gasoline. So just something to think about. Number two, buy an EV.
okay, I can't buy an EV. A lot of people are buying EVs. Tesla sold, 600,000 units year to date. That's close to double of last year. The F-150 is for sale right now. Sales are brisk. So, that's another thing that you can do as well. And, I think that the point 3 is, investing. And it is true that when the price of gasoline goes up and you're feeling pain at the pump, well, guess what? Big oil's making out. And you look at the companies that the president sent the letter to. It's Exxon, it's Chevron, it's BP, Shell, Marathon, Valero, and Phillips. And, those companies do well during these times.
They're doing awfully well. Is there any meeting in the middle where we can ramp up production a little bit, or are both sides just going to stay in their corners until we get to an election?
Well, I think there's things around the edges. I mean, to be fair to the oil companies, the production is pretty much, near capacity, right? There's not a lot of more room for them to move. I think that around the edges there are some transitions they can make at certain facilities. The president can also talk to Canada. He can talk to OPEC about getting some relief there. So it's probably the case
the Saudis in his case, right?
The Saudis in his case, his new best friends. And by the way, you guys have mentioned demand destruction. If the price goes up to 6, demand will drop. And then we'll see prices fall back down probably.
Yeah, I hope we don't see $6 a gallon, but I don't know.
Yeah, it could happen.
Around 5, it certainly could happen.
Usually it doesn't peak till August, right?
Yeah, I know.
We still got a ways to go.
All right, Andy Serwer, Yahoo Finance Editor-in-Chief, thanks so much for joining us. Have a great weekend. Well, coming up, we will discuss Elon Musk's latest legal trouble over an alleged Dogecoin pyramid scheme. We have the details when we come back. Legal trouble for Elon Musk, a Dogecoin investor suing him, accusing Musk of running a pyramid scheme to inflate the price of Dogecoin. Alexis Keenan has more on this for us. And Alexis, what can you tell us about this suit?
Okay, so this one, and Elon Musk has a lot this week, so we got to keep them straight. This one comes from a Dogecoin investor, and his name is Keith Johnson, and he wants to have this lawsuit certified as a class. So it is brought in a federal court in Manhattan, and what he wants is $258 billion. See, that's
billion.
That billion with a B. And what he says is that Elon Musk, SpaceX, and Tesla are all responsible for manipulating Dogecoin to the point that it has had such vast fluctuations in both its price and its volume of trading that they need to be responsible, and they need to pay this money to the investors during a certain time frame, right? These shareholder lawsuits are usually during a certain span of time. They're saying that this was taken advantage of by Musk and company, that they are benefiting. But what's not part of this lawsuit is we can't see what that benefit is. There's no allegation or evidence there yet to say Elon Musk, SpaceX, or Tesla bought at price X and sold at price Y. So let's take a look at the time frame of concern. Particularly, it's about April 2021 through June of this year. But the lawsuit goes all the way back to April 1st of 2019, when the market cap was 250 million with an M. At that time, and note it's April Fool's Day there, the day after, Musk tweets that Dogecoin is his favorite cryptocurrency. So that's sort of the entree of Musk into this territory. Go forward to May 2021, there are some huge escalations in price that coincide with a lot of tweets from Musk. You've got 25% escalations in price. You have 500% escalations in price. Then you get all the way to June, when the price had dropped to $7 billion from a high of $86 billion. And that's what the investors are concerned about here. They want to make up that spread.
Well, I'm sure Elon Musk's staying very busy, as you mentioned this week. And staying in tech, Alexis, here in my home state of Maryland, workers at one Apple store here voting to unionize. What can you tell us?
Right. So these are workers, Rochelle, who are voting right now. The vote is underway. They're in Maryland. It's in just a suburb just north of Baltimore, and it's a retail store. So think of those Genius Bar workers, the folks that help you when you walk into the Apple store. They would be the first Apple retail workers in the United States to unionize if it does go through. Now, the vote has started on Wednesday. It will conclude on Saturday by 8 p.m. That's when we're told we'll get the results. So it'll happen over the weekend. And they're complaining that they want a seat at the table. And what exactly does that mean? Well, one of the workers from this Maryland store talked to an organization called More Perfect Union, and she explained why she wants to unionize, along with some other workers as well. So let's take a listen to that.
We are kind of the face of a giant company. Especially over the course of the pandemic, people have become really reliant on their technology. And when they don't have, their thing that works, they get really emotional. And we tend to be the person who takes the brunt of that kind of frustration and anger and fear. And it can be a lot.
You're acting as like a therapist to people. Like, I've had people cry on my shoulder. We've also had people threaten us with violence multiple times.
So those workers there are saying that they want to have control over the conditions of the store. Pay increase also an issue there. But bottom line, we will hear the results on Saturday, and we'll bring that to you next week.
Okay, Alexis Keenan, looking forward to that. Thanks so much. Great stuff. Okay, well, the talk of a recession and a concession by Fed Chair Jerome Powell that he is willing to let unemployment increase, force Americans back to the office. And how might that return impact the retail sector? Kevin Lavelle is the founder of men's work leisure brand Mizzen & Main. He joins us now. Great to see you, my friend. So what does your research tell you about work from home and how our clothing patterns are shifting?
Yeah, thanks so much for having us. We've seen an explosion of research in men looking to figure out how to go back to the workplace. Over the course of the last year, Google Trends show search for dress shirts is up 40%. Our own customers and our own on-site search is up several 100% in terms of dress shirts over those more casual options. And at the end of the day, guys have gotten used to working at home and feeling a lot more comfortable. And this is why I created Mizzen & Main a decade ago, to bring the best of stretch performance fabrics to traditional menswear. So our offering is saying, if you liked those stretchy athleisure clothes when you were working at home, but you need to go back into the office or perhaps look a little nicer on Zoom, we're here for you.
And it's interesting. I couldn't believe that in the past 12 months, 60% of the respondents that you surveyed shopped for work clothing at an athletic retailer. Is that going to be the new norm? People want that sort of blend of comfort as well as the sort of business smart.
Yeah, absolutely. There's no going back to the clothes that require ironing and dry cleaning all the time, that don't stretch, that just make you feel stiff and uncomfortable. People have just changed their expectations. Mizzen & Main started about a decade ago, as I said earlier, and there are a number of other brands that are now crossing really the chasm between pure athleisure and that traditional performance and pure athletic. It's a hard blend to find at this point in time. One of the things that surprised us is the significant increase in number of searches for polo shirts. It's that kind of that perfect blend of business casual, but totally casual, sneak out to the course sometimes. We know guys are doing that, play a few holes in between meetings. But ultimately, the expectation is I want to be as comfortable as I was over the last few years sitting at home on my couch, even if I have to be dressed up on Zoom or going back into the office.
Kevin, we've been talking a lot about inflation and how that's impacting consumer behavior. Are you seeing a result of that? Are you seeing consumer trends change because of higher prices?
We haven't yet seen a slowdown. January through May this year over last year, we're up over 80%. So we're seeing continued strong demand. That said, we are seeing significant pressures on our supply chains. We're seeing a lot of pressure on the raw material and labor, and certainly freight. Our freight is up many hundreds of percent over last year. And so one of the things that we are working through is just trying to work through that timing and better manage freight and better manage getting those products to our customers in the time that they expected, while acknowledging that there are so many fluctuations. Ultimately, the question that a lot of customers are asking is, how far will my dollar get me? And we're trying to make sure that we can hold the line as best as possible to deliver that value for our customers.
Kevin, TikTok in this world has become an advertising juggernaut for brands, in particular like your own. One particular video you have has been viewed 3.7 million times, shows somebody working from home at the office, but he turns out to be he's out on the golf course. How big is this for the bottom line for companies like yours?
You know, I can't stress enough that organic marketing, the sense of love of the brand, is more paramount than ever. With the privacy changes that Apple has been instituting and Facebook as well, advertising is just getting all the more complex and all the more difficult. And so it's just that much harder to connect with customers, especially in an ever busier and noisier world. And so putting out exceptional content that resonates with our customers, that gives them a smile, and really resonates with who they are as a person and how they want to show up. This video that you're showing was at some of the peak of the work from home times, and our creative director and team came up with this hysterical skit. We just want to keep creating content that our customers are going to resonate with. And really that organic nature of brand building, again, more important than ever before, because the ad market is just more complex, more difficult, and more expensive than anything I've seen in the last decade of building a business.
Kevin, there certainly is a lot of demand in your space, but you're up against pretty fierce competition. How have you seen that play out? And I guess, what are you doing to distinguish your brand from some of the other bigger, well-known brands that are in this space?
Yeah, it's been an amazing thing to see the changes in our industry. When we started, no one was using performance fabrics in traditional menswear, and now almost every brand is doing something similar. So for us, it's ultimately about continued innovation with great new products at that high quality and just making sure that we deliver for our customers, being where they are. So we have a number of our own retail stores. We're in several hundred retail stores across the country that carry our product. And of course, online, make it easy for everyone. But then, as I mentioned earlier, with the brand and branded content and organic content, we want to be the brand that represents who these guys are. Competition will always be fierce and seems to be getting fiercer, but people aren't just looking for a product. They're looking for a brand that is an extension of who they are. When you put something on, it says a lot about who you are as a person. And so we just work to stay connected to our customers, give them that fun content and escape and respite. And then with the celebrity endorsements that we've had over the years with JJ Watt and Phil Mickelson, just continue to raise the profile and introduce ourselves in new and exciting ways.
Kevin, obviously with a lot of post-COVID consumer trends and changes there, where do you see the company expanding beyond where it is now?
We still have so much runway just with our normal product lines. The biggest explosion over the last 2 years, has been in golf. There's no surprise to anyone paying attention to golf stats. The interest in golf seems to be at an all-time high. And while we'd always had kind of a toehold in the golf world, and that increased with our partnership with Phil Mickelson, we ultimately have seen just an enormous expansion of interest in clothes that can blend from the workplace into golf. So we are going to continue to expand great new product offerings there. We've done performance hoodies and water-resistant jackets. So if guys are playing in colder weather, right now temperatures are hot all across the country. So we've certainly got guys covered there too.
You mentioned Phil, and that was the first time a lot of people discovered your brand, that viral ad where he's doing a little dad dancing, which was spectacular. There he is. He's got this big kick. He has become a pariah out there. I'm curious your take on, are you surprised at the demonization of this guy who's one of the more beloved athletes on the planet? I'll put myself in the camp of, I think it's way too much for a guy that got paid $200 million to go play some golf. What's your reaction to it, and how advertisers have fleed him as well?
Yeah, so we had a 3-year endorsement deal with Phil, and it was an amazing partnership. We were thrilled to work with him, and at the end of last year, that deal came to a close, and we were in talks with him when all of this stuff kind of unfolded over the last few months. I know Phil to be a great guy. He's a family guy. He loves his wife. He's been a great ambassador for the game of golf. He's been a great business partner and a friend to us as well. I do think there's been an overreaction, and ultimately some people end up being lightning rods for an issue that gets a lot of attention. I think you saw some of that frustration boil over in the game of golf from the golfers over the course of the last few days, sort of saying, let's get back to being able to play golf. And those were from some of the guys who are staying on the PGA Tour.
Yeah.
I think an expanding pie is good for everybody. So I'm excited to see the direction of golf for everyone involved.
And the fans still love him. And just before we go, you're not on the golf course right now, right? Because I know that viral ad you put out, it looked like the same backdrop. Is that a golf cart or your office?
So it's important to say that Zoom's virtual backgrounds are exceptional, and I'll just leave it at that.
He's on the golf course.
Yes, indeed.
Right,
thank you very much.
A big thank you. Kevin Lavelle there, Mizzen & Main's founder and chairman.
Thank you.
All right, well, staying in sports, actually, the Golden State Warriors back on top after winning the NBA championship. That title coming with a nice boost to the team's valuation. More coming up. As we end the week, let's get a final check at how the market settled. This market check brought to you by Tastyworks. As we see there, a mixed day after a tumultuous few days after that Fed announcement of 75 basis points. The Dow there just down slightly in the red there, 0.13% there. The S&P 500 up about 8 points there, still relatively flat at 0.2%. And the Nasdaq, though, usually the biggest loser on the day, the biggest winner this time, 1.43%, up 152 points.
All right, let's talk about sports because Golden State Warriors defeating the Boston Celtics for the team's 4th NBA championship in just 7 years. And that winning streak is certainly having a huge impact on the team's valuation. Our sports reporter, Josh Schaefer, is joining us now. And Josh, just break this down for us because it's incredible to see the value rise as they win championships.
Yeah, Shauna, it really is. So we'll start with their valuation right now. This is as of last year, 2021, Forbes number $5.6 billion for the Golden State Warriors. And then when you look at, we can pull up a chart here of kind of the numbers through the years and from when they were bought in 2010, you can see, so Joe Lacob and Peter Gruber bought this team for $450 million in 2010. The value's more than 10x since then. And so they won in 2015 with Steph Curry, right? That's $1.3 billion there. Then the NBA has its new broadcasting deal in 2016. That shot up all the teams' valuations because that was a huge broadcasting deal. But really what we've seen the Warriors do that a lot of teams haven't done is they're willing to pay this luxury tax. They paid $184 million in luxury tax this year. That's more than most teams spend on their salary cap as a whole. The luxury tax is something that comes extra. When you pay players too much, you have to pay this luxury tax. So they've invested in that. Then what that did was it brings their valuation up, right? They're able to buy the Chase Center, $1.4 billion. The Warriors funded that themselves. That was an investment back into the team. They have real estate around there. Uber rents offices from them that are right there. So then they've talked about this in the past. You've heard their executives sort of reference Disney. They have the characters, right? You have Steph Curry, Klay Thompson, Draymond Green. So they have those Disney-like characters. Then you build Disneyland with the Chase Center. And then they have the NFTs, and you build it all out, and now you can just keep growing, and it kind of goes beyond sports. Yeah. You have real estate properties. It's crazy how it works.
It isn't. It's incredible to see what they've built over the last several years. And Steph Curry, he's not going anywhere, so maybe we'll see a few more championships there before he's done. All right, Josh Schaefer, thanks so much. Dave?
You will see more championships. From basketball to golf, the U.S. Open continues today at the Country Club in Brookline, Mass., just outside Boston. That was also the site of the legendary U.S. Ryder Cup win back in 1999. And much like that day, the golf world is once again split in two. Those who have joined the Saudi-backed Live Golf Tour and those who refuse. Jay Busby is a senior writer for Yahoo Sports. He joins us now. Jay, great to see you. Been quite a while. Let's start with Phil Mickelson. And before we get to the reaction, let's talk about the golf. He missed the cut plus 11. Does all of this seem to be impacting him?
Without a doubt. I mean, unlike the Golden State Warriors, Phil is having a whole lot of trouble with Boston and specifically the course. He was unable to put anything together for any kind of run these past 2 days. And he finished, as you mentioned, at plus 11. He never looked like he had form. This is the first time that he's played on U.S. soil since late January. So it's not really a surprise. But the sad thing, if you're a fan of Phil, is he doesn't have that U.S. Open. He hasn't won that to complete the career Grand Slam. He's got 6 second-place finishes, and those are fading further and further in the past. So it's looking less and less likely that he will ever be able to get that fourth jewel in the career Grand Slam.
Yeah, it doesn't look likely. Then there's all this controversy. Arguably the most beloved golfer on the planet, maybe with the exception of Tiger Woods, has turned into an absolute pariah, in particular in the eyes of the media, for his decision to take that $200 million from the Saudis to play on the Live Golf Tour. It looked, at least to me, that the crowd still loved him. What did you see in the reaction? And what does that tell you about how potentially, with all due respect, how out of touch the media is?
Well, I wouldn't necessarily say that the media is one unified block on this. There's certainly plenty of people who will take Phil to task for the way that he and the PGA Tour acted. There are others who understand that, hey, this is a complicated world. Echoing Rory McIlroy earlier this week, if you trace money back, everybody's hands are dirty to one degree or another. And so it's difficult to really come too hard down on Phil if you look at not just other sports, but other organizations, other media organizations, other professional organizations like the PGA Tour. So it's tough to get too sanctimonious. the one organizations that does have an option to dig a little bit deeper into Phil's past are the families of the 9/11, those lost in 9/11. I'm sorry, they have been very critical of Phil and the other live golfers for their connections to the Saudi government. But outside of that, there's a whole lot of grandstanding that's going on here, and I agree with you. It seems a little bit out of proportion to what's been said and what's been done.
Not a single member of that media would not take 9 figures to go play some golf for the Saudis. Dustin Johnson has joined, Bryson DeChambeau has joined, Patrick Reed has joined. They have 9 major winners on this live golf tour. Do you think any more big names will make that move, or is that it?
I do think there will be more big names. I do think there will be more major winners. I think there will be, the issue really isn't so much the big names of today, it's the big names of the future, or the players that would become big names in the future, the players that we don't yet know, but if they were to go on a normal path, would be winning Masters in 2025, 2030, 2035. If they decide to go to the LIV Tour, that's where this really becomes an issue. So it's not so much worrying about the players of today, it's worrying about the players of tomorrow that really ought to have the PGA Tour concerned.
Also a question of sustainability here, because LIV paid those players about $500 million, 4 players, and they'll pay out $255 million this year. Is this really a sustainable effort when clearly nobody was watching, at least on week 1? And long term, how do you think this ends? Can the 2 tours coexist?
Well, that's a couple of questions there, and it's a couple of tricky questions. In terms of sustainability, this is not built like the PGA Tour. This is not a business proposition where they need to see profits bottom line profits in order to be able to consider this a success. For the Saudis, this is a marketing operation, not a business investment one, where they are trying to market an image of Saudi golf, an image of Saudi stability. They're looking forward to a world without oil, or where oil dependence is less. And so they realize that they're going to have something more to offer the world. And this is a long-term play. And in terms of the money that they've got invested, it's a ton. They have invested, they've guaranteed already $2 billion. They've got a fund with $600 billion. So $500 million is a relative drop in the bucket here. In terms of how long it can last and in terms of whether they can coexist, absolutely they can coexist. The question is whether LIV golf players will be allowed to play in the majors like this week at the US Open. If they get that ability to play in the majors, absolutely you're going to see other players saying, hey, I want to make some money and I want to play in the majors. The PGA Tour, thanks, but no thanks.
Yeah, as long as the majors remain independent of the PGA, it looks like this dynamic will continue a while. Jay Busby, senior writer at Yahoo Sports. Follow him at Jay Busby for more updates on the U.S. Open. Good to see you, man. Thank you. Rochelle?
Thank you.
All right, thanks, Dave. Well, U.S. stock and bond markets will be closed Monday for Juneteenth, but the stock I'm watching for Tuesday is Lennar. Now, the home construction giant reports before the bell and will be one to watch, especially considering the cooling housing market in light of rising interest rates. Now, we already saw that Home Depot and Lowe's fell to 52-week lows Thursday, and confidence in the market for new single-family homes fell to the lowest level since June of 2020. That's according to the National Association of Home Builders. But of course, Lennar has actually topped earnings per share estimates for the last 2 years running. It also had a revenue beat 75% of the time in the last 2 years as well. Well, speaking of brands, trust is often built over time and lost in an instant. A look at the brands you trust most, according to a new poll from Morning Consult. We'll see if your favorites made the list next. Brand loyalty is key to sustaining a business, but high prices or political stances might be impacting consumers' choices and their trust levels. For more on this and the most trusted brands, let's bring in Joanna Piacenza, Morning Consult Head of Industry Intelligence. So I want to first talk about some of the results from your survey here. Talk about the most trusted brands and how they got those accolades.
Yes, this is going to be decades and decades of delivering on two of the biggest trust builders per our research. That's good value for price and high quality products and service. Now, trust is not built overnight. So when you look at this list, when you look at these rankings, these are household names. These are brands that have been around for decades and built up that trust.
Does it predict brand loyalty, though? I guess how likely are consumers, because they trust the brand, to actually seek it out and buy it as compared to some of its competitors out there?
It's a good question. So we track about 9 different metrics in Morning Consult's brand intelligence. That's our brand tracking platform. And what we found is that consumer trust, saying that you trust a certain brand, has the biggest equal sign to purchasing intent and loyalty. So more so than favorability, more so than usage. That's why we really wanted to do this deep dive on consumer trust.
We just put up the top 5 there, here in the United States anyway, which was Band-Aid, Lysol, Clorox, UPS, and CVS. What to you is the biggest common thread among those companies, something that others can learn from?
Well, I think if we did this list during a non-pandemic year, we might see those brands differently, right? Yeah. Clorox, Lysol, there's some pandemic influence going on here. But that said, these personal care and health brands, those are the brands that, again, have been along for a really long time. They have a low price point. They consistently deliver on value. And while they might not be the brands that we see in the headlines all the time, it's a good thing. Sometimes press is not good press. These are the brands that are consistently there delivering on their products. And this is a ranking that a lot of brands want to be on.
And in terms of the size of some of these companies that people trust, they did tend to gravitate towards smaller companies rather than some of these large corporations. Why do you think that is?
I think that there is some consumer sentiment away from some of the larger big tech corporations, but it's interesting you bring up smaller businesses. We had some interesting takeaways in the report that not in every market where we ran this survey did everyone have a lot of trust in very small businesses. So it really depends on what market, what country you're in.
Tell you what, it bummed me out. The trust in the media, the news media, is lower in the United States than anywhere in the world. Does not include Yahoo Finance. We're pretty certain. Joanna Piacenza, thanks so much. Great information. We appreciate it. With COVID nearly in the rearview mirror and the international travelers no longer required to show a negative test, is Broadway finally back? Will it ever be the same? Yahoo Finance's Ali Canal here. Ali, nice to see you. So Top Gun really showed us that people will return to the movie theaters. Is there an equivalent? Are we seeing a return to Broadway?
I think what's happening to Broadway is similar to what we're seeing at the box office, right? Top Gun, Jurassic World, they're killing it. But some of those more middle tier movies, they're struggling. And the same thing is happening with Broadway. Hamilton, Wicked, Phantom of the Opera, those performances have no problem filling seats. But the plays and some of those lesser known musicals, they do not really they're not able to fill the seats to the level that some of those bigger productions are. And if we take a look at overall Broadway attendance from last week, you'll see that attendance came in at around 85%. That is lower than pre-pandemic levels, which came in right around 94%. Still not totally terrible. I did get the chance to speak with Broadway producer Ron Simons. He told me that there are a few things that Broadway needs to change in order to get back to those levels and really create a new Broadway. One of those things is making sure that you have diverse stories in order to bring diverse audiences, in order to maximize your income. You want to make sure that you're not pricing people out of the market either, so that you're offering diversified pricing, discounts, group ticketing, things like that, because I do think prices are a big issue for Broadway right now.
Ali, going forward, I think a lot of it was at least Broadway in the midst of the pandemic, and also when we were initially starting to see Broadway reopen, they were waiting for the international traveler. Now we're seeing the international travel seemingly coming back. Do they expect that to provide any sort of a boost here over the next couple of months, especially since we're right in the middle of summer?
Yeah, so I spoke with Charlotte St. Martin. She's president of the Broadway League. She did specifically cite the easing of those travel restrictions that should help this summer. Summer is usually a pretty big time for Broadway, but there is some concern because we're seeing some award-winning shows like Dear Evan Hansen, Come From Away. Those are two of my favorites, by the way. They are closing in the fall, which is I'm super bummed about. But Charlotte told me that honestly, nothing to be concerned about. This is just a cycle in the business of Broadway. Shows close and they open, and this fall we will have 40 total Broadway shows.
And Ali, I'm heartbroken. My annual birthday treat used to be to treat myself to a Broadway show. I still haven't gotten to see Tina. That one is still on my list.
Well, you gotta hurry because they're also closing. You gotta hurry for that.
So then, in terms of new productions, can we expect anything, or are we still waiting for some of the ones that had to sort of close or sort of shut down temporarily during COVID to come back?
I think that is the goal. I think all of these producers really want to have as many new productions as you can in order to bring, again, those different types of audiences. That's how you're going to get more people in those seats. That's how you're going to increase those revenues. So I'm sure they are working on a lot of things right now, but of course, we're still going to have those staples like the Phantom of the Operas, the Wickeds. Those are also my personal favorites. But I do agree that we need some fresh blood up on Broadway. We need some different shows.
I haven't been back to Broadway since before the pandemic, so I'm part of the end.
I went in December, masks and all, to see Come From Away. So I'm excited to get back with no masks this time.
Me too. All right, Ali Canal, thanks so much. We are going to take a quick break, but when we come back, Summer Fridays, they're getting more and more popular with employers across the country. But are they here to stay? We will discuss when we come back.
employers are trying to sweeten the deal to lure and retain talent. According to data from job platform ZipRecruiter, listings offering summer Fridays are up 56% from last year. Now, for those of us who've never had one, this means you get to finish work after lunch on Friday and have a nice early 3-day weekend. Now, it's actually believed to have started in the 1960s to sort of perk people up in those lazy summer months. But maybe this could help usher in the 4-day work week, Shauna.
Maybe. I like the optimistic thinking. I would be a big fan of the fact if we only had a 4-day work week. Like you mentioned, we have never had the opportunity to take advantage of summer Fridays because we're in the news business. So we clearly picked the wrong
but Yahoo
business to go into.
does, right?
But Yahoo does. I guess Yahoo, we just can't participate. All right, I want to put up a poll because we asked you guys, our viewers, our followers, whether or not your company allows you to take a summer Friday. And when you take a look at the results, it might be a little misleading because 82% of you said no, 17% said yes. I think you guys are being totally honest. But my feeling on this poll, Dave, was that, hey, it's only people that are in the office right now working on Twitter that are participating. So we might have to do this on a Monday.
I think that was a nice evaluation. I think that the likelihood, if you're on a summer Friday, you are not on Twitter. So yes, those numbers probably are skewed. They do say that employees are 2.5 times more likely to say they are happy at work if they like the working schedule and flexibility. So clearly this works for both companies large and small, and we are on board.
We are on board.
If only.
We just need the 4-day work week.
That will do it for us. Have a terrific weekend, everybody. Happy Father's Day to all you dads. We'll be back here on Tuesday, Monday, celebrating Juneteenth. Enjoy the weekend, everybody.